Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a quarter percentage point.
They're kind of on an autopilot to get rates down to around 4% in the early part of next year, and then we take it from there.
You've got to preserve the economy in some sort of steady state. We're too high right now.
As you get into next year, listen, I mean, you got what could be a pretty significant policy changes.
I think Jay Powell will want to preserve optionality for 2025. A lot can happen.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
What a week. Let's get you to the weekend. Let's get us all to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market down just a touch on the S&P. We're negative by 0.2%. On the Nasdaq 100, we're down by 0.4%. Yesterday, all-time highs, 3-day winning streak, the best week of the year on the S&P 500 so far. Just about holding steady on equity futures. On the Russell, we're down 0.2 on the week. Small caps up almost 8% this week. Check out the bond market, 2-year, 10-year, 30-year. If I asked you where you thought yields had been this week, I'm sure you might say it feels like they're higher because we were up so late Tuesday night, seeing them so much higher. They're actually down on the week by almost 10 basis points. We're down another 3 on a 10-year, 429.
So basically, the only move that stuck was the good one, and the bad one faded pretty quickly. And that's the takeaway here, as people really assess how quickly Donald Trump could put into effect the policies that could be potentially inflationary. Basically, for bond markets, it was sell the rumor, and then after some thought, buy the news. And for equity markets, it was buy the rumor, buy the news, and keep on buying, because guess what? Everything's going to be good for them.
We've still got some work to do. Still going into the weekend. We need to work out if they actually get the trifecta, if Republicans get the House. We're talking about narrow margins here. We'll work through those margins through the programme. And then we've got to start forming a cabinet. Work out who's going where, what positions do each individuals that we've had on this programme get in the coming months?
Exactly. We need to know the composition of not just full Congress waiting on those House votes. It might come down to 218 versus 217, which basically means every single representative ends up being a king, but likely they'll fall in line with the former president. But that will matter in how much he can enact his tax legislation through. When it comes to the cabinet, one key pick last night announced by the former president and future president Donald Trump, Susie Wiles. She is seen as a very competent individual inside and outside the Trump camp. She is someone who likes to stay in the background. She will be a physical human moat around President Donald Trump, and she will decide who gets access to him, and she will have those potentially unorthodox voices stay outside the West Wing.
More on some of the names circulating throughout this morning. Let's start with the price action. Equity futures down 0.2% on the S&P 500. We've got a lot to talk about on this Federal Reserve and what happened in that news conference. We'll do that in just a moment. In the bond market, yields are lower by 3 basis points. The 10-year 429.65. Coming up this hour, we'll catch up with Sebastien Page of T. Rowe Price following the best Fed day of the year for equities. Rob Casey of Signum Global Advisors as control of the House hangs in the balance, and Dan Tobon of Citi as investors dial back Trump trades. We begin this hour with stocks sitting near fresh record highs following the Fed's 25 basis point rate reduction. Chair Powell reducing interest rates and pointing to US economic strength. Sebastien Page of T. Rowe Price writing, I'm relatively optimistic about the US economy, but equity valuations and spread levels agree. Hence, opportunities to significantly overweight risk assets unlimited. Sebastien joins us for more. Sebastien, good morning.
Good morning.
It's good to see you. What a week, eh?
Yeah.
What's changed for you and the team?
Well, it's been a stressful week for everybody. I think the country's, sleep deprived. We were slightly long risk assets going into the election, and we still are. I think the economy is going to do just fine over the next 12 months.
When you say long risk, let's work through risk assets. What do you like more at the moment within equities, large versus small, geographically, the US versus the rest of the world, away from equities within credit? High yield spreads have been really tight going into this election. How are you thinking about those things?
We're long value stocks, neutral between small and large caps in the U.S. So neutral means we're kind of missing the rally right now. We're actually long international small caps. They happen to have double the return on equities of the U.S. small caps and have been dragged down together with global small caps. Otherwise, between U.S. and non-U.S., we're at neutral. It's not an environment where we like to take very large positions. And as I said, we have a slight overweight to stocks, overweight to cash, we're short bonds, and we're just navigating through this.
You said that a lot of this good news or euphoria that the markets are extrapolating out has been priced in, which is the reason why you don't see a lot of opportunities. I want to understand what actually is the scenario that's being baked in. Because the knee-jerk reaction was less regulation, fewer taxes, possibly some other aspects that would juice growth, that would be positive for corporations but negative for bonds. And then the bond market said, actually, it'll be fine for us too. Which do you believe? What is the scenario that they're pricing in?
If you look at the day after the election, it looked like, first of all, you take out a lot of uncertainty. So, that's good for stocks. But then you have, I think, three factors. You mentioned them: deregulation, lower taxes, and inflation. But Jonathan mentioned earlier that 10 years actually round-tripped. So I think that's the knee-jerk reaction of the market. I go back then to fundamentals. How's the economy doing? You can still squeeze a bear narrative if you look at manufacturing PMIs, the yield curve, and then the change in unemployment. But the bull narrative is just so much stronger. Citi Surprise Index is up. The services PMIs are at 56. The unemployment is still low. The Fed is easing. We have fiscal pedal to the metal. You have a lot of good things.
Okay, so I'm laughing because I remember you talking about the fights that you'd get between bulls and bears at your different investment committees. And I imagine now that the bulls are sitting there pounding their chests and the bears are kind of slinking into the corner saying, "You want me to get you some coffee?" I mean, is that the tone right now? Or do you feel like, there's a little bit more of a clear-headed look at what's been baked in, et cetera?
Look, we don't call it fights. We call it
constructive discussions.
Yes, robust debates.
Okay.
And as I said before, it's usually the bond managers that look at the pessimistic side and the stock managers that look optimistic, and the rest of us in the committee who are multi-asset investor are trying to figure it out. Yes, it's difficult to make a really convincing bear case. The ones that I still hear nowadays are, again, there always are these days, around the increase in unemployment. And that's a 70 basis points increase in unemployment. That's the delta. But Jonathan, unemployment's at 4.1. That's actually low by historical
It dropped back again.
And the 30-year average is 5.6%. So it's robust employment.
Well, this is a reason why I think some people are saying that the only bear case could be valuations, and that one aspect, and you're sort of seeing this in flows, where even though the United States had this inflation potential reemergence in at least the zeitgeist, you saw a pretty huge weekly inflow into U.S. bonds, and you're not seeing the inflow into European bonds, even though the European economy seems to be much more bearish in nature, and a lot of people are expecting the ECB to cut more significantly. At what point do you start liking overseas because of the pessimism that's baked in?
So, we have a small overweight to emerging markets. We actually scaled it back after China rallied so much on the first round of stimulus. But overall, we remain neutral. I think the U.S. economy is just doing so much better than the rest of the world. I agree the valuations look higher, the S&P 500 at 21 price-earnings ratio, and the spreads, the credit spreads this week have tightened. And so we're really baking in a lot of optimism. But if I look at that 21 price-earnings ratio and adjust it for fundamentals, we're doing research where we're looking at the return on equity and going back in time and adjusting valuation for the quality of the fundamentals. And that takes us from a 95%, 95th percentile valuation, close to all-time high, down to like 60th, 65th percentile if you adjust for return on equity or margins or fundamentals. It takes us back to 2015, 2016. So yes, it's expensive, but that's why we kind of still end up neutral between the U.S. and non-U.S. I don't like being in the media saying we're neutral because it's not exciting. But this is kind of a time in markets where, we bring things closer to the middle.
The conventional thinking ahead of the election was a red sweep would mean bad things like tariffs for the market, but good things like tax cuts. Well, tax cuts are going to get really difficult if the margin is so slim in the House of Representatives. I mean, potentially it will be 218 to 217. What do you think gets done?
And I think the problem is that we've had so many promises. Like no taxes on tips, no taxes on Social
Oprah
Security.
Winfrey election.
No taxes on overtime, lower corporate taxes, and then you take away the inheritance taxes and the capital gains taxes. So I don't think all of that is happening, and we don't really know until we know what happens with the House. So maybe, Anne-Marie, you make a really good point that this initial pop, this enthusiasm bakes in a lot of fiscal stimulus that, we're still at 6-7% of GDP in terms of deficit. So maybe there's a little bit of a short-term overreaction. But since the day after the election, markets are sort of stabilizing.
Right, because I think a lot of markets are also pricing in deregulation, which you talk about. In what sectors do you think that we're going to see that play out the most?
Yeah, and that was very stark the day after the election. You saw small cap stocks. You said 8% for the week. You saw
almost,
energy. Yeah. You saw financials. That really, I think that is real, and it loosens up the M&A activity, and it's meaningful. So I guess it's what is the market sort of missing? With the 10-year doing a round trip, I think the market is missing some upward risk in inflation. And, the 10-year could pressure equity markets. It's this tension between the 10-year and the equity markets that remains unresolved.
What's the danger zone on the 10-year? I've heard things like 450, and we fell just short of 450 this week. Is that the point where you think maybe it starts to constrain equity markets?
I don't know. I can tell you that our head of fixed income at T. Rowe Price thinks we could go to 5% within the next 6 months.
Wow.
And I think that could shake up markets. And it would probably come with some concerns about an inflation shock, which could probably come from a commodity shock, which would probably, I'm using a lot of probablys, but we don't know.
I understand, but they're all things we've got to think about.
It probably come from a geopolitical shock. And, if you look at the day after the election and the 10-year went up 17 basis points right away, the 10-year inflation swaps went up 11. So you can infer that a fair amount of that move was inflation-related.
You've provided more analysis of the last 60 seconds of that bond market move than Chairman Powell did in 45 minutes. He didn't want to touch it. Do you think he opened the door to a pause in December?
I think, look, his messages were the economy's fine, we're doing fine on inflation, we're not ruling in or out the December cut, and I'm going to take him at his word. And we're all sleep deprived, right? So we're giving short answers. It was the famous no answer.
No, and then
right?
no again. Not permitted under the law. We're going to do that a little bit later. Do you want to weigh in on that? Do you think they can weather the storm when that political threat comes down on them in the next couple of years?
I think so.
OK. Sebastien,
short
and sweet. I appreciate it. Seb Page at T. Rowe Price. It's very difficult to get your head around the kind of policies that will get executed down in Washington, D.C., particularly when you talk about the margins we could be working with in the House. You brought up the bond market move. I think there's a difference between pricing in existing tax policy, which is the extension of the TCJA from several years ago, and pricing in new tax policy, because $4 trillion of tax cuts were on the table here. They either expired next year or got extended. And basically what we found out, potentially, we're almost there, that will get extended.
Likely will get extended, and then how much more can you add to that? Because Donald Trump has come out and given a plethora of more tax cuts he wants to enact. Can those actually get done? These are not part of the ones that are TCJA that even wants to extend. He also wants to bring down the corporate tax rate even lower. How much can this get done when you have very slim majorities in Congress?
We'll talk about those margins in just a moment. Equity futures on the S&P 500 a bit softer. We're down 0.2%. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Nippon Steel says that it still expects its acquisition of U.S. Steel to be completed by year-end. Vice Chair Takahiro Mori says that discussions can be constructive now that the U.S. election is over. He's hoping to visit the U.S. this month and meet with union leaders. The $14.1 billion deal has faced opposition from unions, and President-elect Donald Trump also said that he would block it. Boeing CEO says that furloughed workers will be paid for lost time. Kelly Ortberg wrote in a memo to staff, quote, "As we navigate through the work stoppage, we asked many of you to take a furlough to support our cash conservation efforts. We want to acknowledge your support by returning your lost pay." Ortberg made the temporary cuts as cash concerns mounted in the first weeks of his tenure, a month before that 7-week strike. President-elect Donald Trump has picked his chief of staff. Susie Wiles, one of the top architects of his presidential campaign, will take the key role in his second administration. Trump says Wiles helped him achieve one of the greatest political victories in American history. She'll be the first female White House chief of staff. And that's your brief. John.
Danny, thank you. More on that story a little bit later. Up next on the programme, on the edge of a sweep.
I feel confident that we will have a House majority in control of the Republicans and that Mike Johnson can be reelected as Speaker of the House. I think somewhere in the low 220s is where we'll end up in the next few days.
How big will those margins be? That conversation up next. Live from New York this morning. Good morning. We're almost there. One more session. Equity futures on the S&P 500 just a little bit softer. Bond yields lower by 2 basis points. Holding on to 430 on a 10-year. Under surveillance this morning, on the edge of a sweep.
I feel confident that we will have a House majority in control of the Republicans and that Mike Johnson can be reelected as Speaker of the House. We have a 220-seat majority now, just 2 more than the 218 that is required for control. And I think somewhere in the low 220s is where we'll end up in the next few days.
So here's the latest. Control of the House still up for grabs with 25 races yet to be called. The current count has Democrats with 199 and Republicans with 211. Rob Casey of Signum Global Advisors writing, broadly speaking, we see Trump beginning his second term unrestrained. Republican trifecta, Supreme Court majority, popular mandate. This may be a once-in-a-generation chance for Republicans to enact sweeping change. Rob joins us now for more. Rob, good morning.
Morning.
Can we start with the trifecta? You think it gets done? What kind of margins are you looking for?
Really tight margins. I mean, it's going to be as tight, if not tighter, than what we're seeing currently. Of the 25 seats still to be called, I think Republicans very easily win or comfortably win 9 of them. So that gets them to 219. There are other seats Democrats will win, and there are about 5 or 6 seats that are absolutely toss-ups at this point. So the best Republicans can hope for, I think, is 220, maybe 221, but it looks a lot like it does today.
House Majority Whip Tom Emmer this morning in Punchbowl News says, I don't care if it's 218, 219, 220. I don't give a damn. As long as we have the majority, we're going to be successful. But if you have 218, basically everyone becomes a king, no?
Yeah, everybody becomes a king. I think it's worse for Elise Stefanik, who would like to be appointed somewhere else, and they don't want to deal with a special election in New York. At this point, that would take away their majority if it was that slim. But, I mean, frankly, Donald Trump is president-elect, which means in the House, Donald Trump is king. I mean, they are going to take their shots not from Mike Johnson or anybody else. They're going to take them from Trump.
So besides Elise Stefanik, who may go over to the UN, what does the leadership look like in the House?
I think it's Speaker Johnson. I think it's Speaker Johnson will stay in his seat. He did what he had to do. I mean, he retained the Republican majority, very likely at this point. And you know, other than that, I frankly don't think it matters very much because I think this will be a session in which legislation is done top down. It'll come from Trump. It'll come from the White House. And the Senate, very likely to fall in line. The House, probably even more so.
So what's the first order of business, the border or taxes?
I think it's the border. I think it's oil and gas, both through executive action. I think taxes will take a little bit longer because we will see, I mean, it's not a budget negotiation between Republicans and Democrats. It'll be a budget negotiation between, you know, the center and the right of Republicans. And we'll see that done through budget reconciliation. That'll take a number of months.
What will the immigration proposal look like? Is it going to be mass deportations?
I think we will hear about mass deportations. I think it's very unlikely we'll see that in the short term, frankly, because it just requires so many billions and billions of dollars to do that there isn't an obvious path forward for mass deportations. I think very, very likely what we see is targeted deportations of, you know, illegal immigrants who have committed crimes on U.S. soil. We'll get, you know, pictures and videos of immigrants being taken across the border in buses, and we're very likely to see remain in Mexico reinstated, but deporting tens of millions of illegal immigrants, really, really hard to do without additional funding from Congress, which would take a lot longer.
You know, one of the most interesting conversations that we've had, I thought, was Representative French Hill yesterday, where we were talking about the budget deficit and his concern about it. And he is a Republican. He is a House member. He is a supporter of Trump. And he poured a lot of cold water over some of the proposals that we heard from Elon Musk and the feasibility of cutting $2 trillion of the budget so easily. So how much pushback will there be within even the Republican Party as far as expanding the deficit to the degree that some people project that the plans would do?
I think there will be some pushback, but I think almost necessarily we will see an extension of the Trump tax cuts, all of them, not just some of them. And there really isn't any obvious spending to cut commensurate with that level of tax cuts. So otherwise put, I think we are going to see an expansion of the deficit almost necessarily.
So work through the kind of policies that were on the campaign trail that you think could get done. No taxes on tips. That happens?
Probably not.
You don't think that happens? Why not?
I think over the past 6 months, what we've seen is Donald Trump run, frankly, a phenomenal campaign. Of course, today we know it was a winning campaign. I think a lot of what he was discussing, does he want to get it done? Maybe. Are they priorities to get done in this first 100, 200 days where we'll see, a bulk of the legislation get done? I think probably not.
So that's one policy. Corporate tax rate down to 15% with conditions. What about that?
Yeah, I think so. I mean, again, the campaign talked about 20%, 18%. I think those were campaign ploys because, frankly, a corporate rate cut doesn't play very well among the working class. I think Republicans are going to do all that they can to get it down to 15%.
Let's talk about inside the White House. Susie Wiles was announced last night. Trump calls her his ice baby. Who else do you expect to join the cabinet?
We see Rick Grinnell at State. If it's not Rick Grinnell, it'll probably be from the Senate, maybe Rubio. It could also be Bob O'Brien, but I would tap Rick Grinnell at this point. We're all asking ourselves who Treasury is going to be. It's Scott Bessent, I think, is at the top of the list. But Howard Lutnick has, I think, become more popular in the campaign and transition teams over the course of the past week or month. So I would look at Howard Lutnick as well.
What do these names swirling around the potential cabinet picks for President Trump tell you about where his mind is and how maybe the next 4 years will play out?
Well, I think the Trump 2.0 team will be more ready to govern than the Trump 1.0 team was. I mean, we have to remember that in Trump 1.0, we also had a Republican trifecta. There was not a lot of major legislation that got done in that period before the midterms. I think we will see a different Trump administration with a lot more momentum, a lot more efficient, with or without Elon Musk, really running the efficiency show. So what I think we're going to see is it's a technocratic cabinet. But it's also a cabinet very, very willing to implement Trump's policies.
You say a technocratic cabinet. Yesterday, Donald Trump came out with the plan to eradicate deep state and started talking about a series of measures to give him the ability to remove certain people, certain bureaucrats, as he calls them, different members of the government. How much are those some of the things that we can expect to hear versus the technocratic aspects that you're talking about?
Well, I think at a very high level, top level cabinet positions, these people are really smart. These people have their hands in policy, and they're going to be ready to go. Underneath that, so some of the more professional, but still policy-related jobs, Trump wants to ensure that those people are pursuing his agenda and not their own. The easiest way for him to do that is to enact something called Section F, which could allow for him to fire up to 50,000 policy-level positions sub-cabinet. Do we think he's going to fire 50,000 people, on January 20th, 21st? No. Do I think that that's a helpful threat for Trump to ensure that the people working under him and under his cabinet are pushing the ball forward? I think it is helpful. So I think we hear a lot more about Section F.
The reason why I ask this is because when you say ready to govern, that can mean a lot of different things. Is it pushing through legislation? Is it looking for the types of provisions that could allow some of these more dramatic provisions to go into effect? Which is it?
Well, I think first it will be done via executive action. And again, I think that the two opportunities for him to do that are on the border. Not so much major immigration reform, but border enforcement in particular. And I do think very quickly we will see that, Trump return to the drill, baby, drill talking points, opening up federal land for more, oil and gas production. Whether or not we see that in the market in the short term, I'm skeptical, but it is what it is. Second, on the legislative front, I think it will be tax focused. I think everything else sort of in the first 100 days probably falls to the wayside.
Rob, it's good to see you. As always, sir, thank you. Rob Casey of Signum Global Advisors, one man to watch, Ambassador Lighthizer. Where does he land in this administration?
I think that's the push-pull right now within the campaign, the transition team, whether or not you put someone like him at Treasury, that sends a really antagonizing message to China, or do you put him somewhere else? Or does he go back to USTR? We have to wait and see.
That's one to watch. Coming up on the programme, we'll catch up with Peter Tchir of Academy Securities. Another thing to watch, China preparing for another Trump administration. That conversation up next. Equity futures just a little bit softer on a record-breaking week. Record highs on the S&P 500, on the Nasdaq 100, pulling back just a touch this Friday morning. Good morning to you all. We're softer by 0.1% on the S&P. On the Nasdaq 100, we're down by a third. Through Thursday, three-day winning streak on the S&P, which, funnily enough, is the longest since September. It's been that long since we had a three-day winning streak on the S&P 500. At the moment, poised for the biggest weekly gain on the S&P so far this year. Switch up the board and get to the bond market. 2-year, 10-year, 30-year. 10-year is actually down on the week, which is difficult to get your head around if you were around on election night and the day after. The 2-year yield is down by 3 basis points on a session. Lisa 417.24. We've got a lot to talk about with regards to Chairman Powell. We'll do more of that in just a moment. But it just felt like on the margin, he was trying to get that optionality that the former Vice Chair Richard Clarida was talking about to pause if they need to.
With this question mark about which policies are going to be implemented, and that question mark really was what was hanging over the bond market. And the reason why you saw this massive whipsaw, what do you start pricing in that this president, the president-elect, will be able to do as quickly as he could do some of the other things? I think that's the reason why you saw a round trip. One interesting note, that on Wednesday, $20 billion flowed into U.S. equity funds. That is the most in 5 months. But guess what? $14 billion went into U.S. bond funds. So for all of the hand-wringing about people fleeing U.S. bonds and the heels of that, the flows don't back that up.
Yields went up and those yields got bought. In the FX market, Euro dollar 107.94, DXY, the dollar index, just about on course for a 6th consecutive weeks of gains, but up on the week by only 0.1%. I know what it feels like. It feels one way, but in many ways we're actually just flat on the week. In the FX market, on things like the euro, just slightly negative. On things like the bond market, we've actually seen a rally through the week. Yields dropping across the curve. Under surveillance this morning, President-elect Donald Trump naming Susie Wiles as his White House Chief of Staff. Wiles helped Trump navigate his 2024 presidential campaign and will be the first woman to hold the position. You would have heard this a few times over the last few months, that this campaign is disciplined. Not the candidate, the campaign. And when we talk about the campaign being disciplined, this is who we were really talking about.
She's the backbone of this campaign. She has the trust of President Donald Trump, President-elect Donald Trump. I was speaking to a source last night who was basically singing through the phone. I have never heard a Republican that's either in the MAGA world or more conservative, traditional Republicans speak ill of her. She is highly regarded. She'll also become the first female to ever have this position. This is one of the most powerful positions in the United States government. And I think probably a morning like today, Mark Cuban is maybe a little embarrassed of his call, a remark that if there's no strong women around the former president. She's very strong. She rarely tweets, and she came out and tweeted about that because she was the backbone of this campaign, and she'll be the backbone of that West Wing.
What's interesting to me is she's both an insider and an outsider, right? I mean, in terms of a Washington outsider, in some ways, she hasn't necessarily been with the backbone of some of the more traditional Washington areas, but she was in Ronald Reagan's campaign back in 1980. She did work with John Delaney. She did work with John Payton. She had all of this political experience throughout that time. So an interesting person for him to choose, and one that I think a lot of people are finding really interesting.
Now for the next few months, focused on one thing, just watching this cabinet slowly come together. Elsewhere, Fed Chair Jay Powell avoiding speculation over potential policies from Donald Trump's White House, but signalling he's ready to defend the central bank from political pressure.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Quite a moment in this news conference. No, and not permitted under the law.
And it was one thing that we observed yesterday. He was prepared for this. This was something that the lawyer, Jay Powell, had thought significantly about, looked at the code, and had a very quick and decisive response. So it raises the question how much the Fed, A, is preparing for this, understanding what a Trump 2.0 administration could look like, and what kind of fight they're putting up to prevent that. At this moment, it really seemed like almost provocative, and it's actually really notable that we haven't gotten any response from President-elect Donald Trump. It sort of leaves this as, well, maybe there won't be a war.
Well, President-elect Donald Trump, he sat down with our colleagues at Business Week, and the question was, if reelected, would you allow Jay Powell to serve out his term? Yes, I would. There's a lot of false information on that. I've had my own disputes with him, but no, I would let him serve out it, especially if I thought he was doing the right thing. Well, he's cutting interest rates right now, and I know for Donald Trump, that is the right thing.
And he could be on course to cut interest rates again in December. We'll see. More on that a little bit later. I want to turn to this story. The Biden administration rushing to complete the CHIPS Act agreements before Trump enters the White House. More than 20 companies still in the negotiation process, including Intel, Samsung, and Micron.
So they want to get this done as soon as possible. What I find so interesting is that Trump 1.0 had talks with TSMC. They wanted them to come to places like Arizona. They wanted to put some production of semiconductors back in the United States. But Speaker Johnson was asked recently, actually in New York, when he was on the campaign trail for a representative, would you try to roll back Biden administration's CHIPS Act? I think he just heard Biden and said, yes, we're getting rid of it, and then had to come out and say, actually, we're not. Either way, the Biden administration did this in a bipartisan fashion. A lot of work went into this from Gina Raimondo, and they want to make sure that these companies get that money, get those grants so they can make those chips in the United States.
China is at the epicenter of so many of these conversations. China is preparing for another Trump administration, announcing a $1.4 trillion debt swap to help local governments as it tries to support an already slowing economy facing new risk from Trump's re-election. China's President Xi Jinping sending a congratulatory message to Trump and said a healthy and sustainable relationship is in the common interest of both countries. Peter Tchir of Academy Securities joins us now for more. Pete, welcome to the programme. For this relationship,
Thanks very much.
Are you focused on the economics of all of this, or are you focused on the broader foreign policy? As a market participant, what matters more to you?
You know, I think they're very entangled, right? I think with China, when we talk about this at Academy Securities, we talk about the four levers of power: diplomacy, information, military, and economic. And as China is our main competitor, there is going to be economic competition. I think there are going to be peaks and valleys where it gets more or less tense. How we've been looking at it is there are going to be certain things that are just sacrosanct, whether it's chips, technology, AI, and there's going to be very little to no grounds for kind of movement with China. I think there are opportunities within the regular sphere of business to do things with China. I think the tariffs are a threat to bring them to the table, and we'll see where all that goes. But yes, we are going to be at an economic kind of Cold War with China, and that's not going to change once Trump takes office.
So, Pete, you think they open negotiations before they fire shots? And by shots, I mean tariffs when they walk back into the White House.
Yeah, I think he's going to announce the potential for tariffs, and he's going to want to see how China responds. That's his behavior, right? Even when they did the first round of tariffs, I think we almost have to go back to 2018, those first rounds of tariffs. One, it built up over a period of time, right? So there were talks, there were to and fro. Markets were reacting to that before he finally pulled the trigger and put them in. And also, if you remember, there was almost universal hatred of the tariffs, right? Almost every single economist that I know came out and said tariffs are awful, trade wars are bad. Turns out maybe they weren't so bad. And right now I'm hearing a lot of this, oh, protectionism fails, you can't do this. Well, China's been running a protectionist economy for 30 some odd years, and they went from nowhere to a real powerhouse. So we have been in a trade war for a period of time. I think the gloves are off. We are going to try and figure this out. I do think, though, the CHIPS Act is going to be, or some version of it, is super crucial. That is something we need to do a much, much better job of manufacturing domestically.
So if the tariffs aren't necessarily going to be as extreme or as quickly implemented as maybe fears initially were, that at least were expressed through the bond market, then what comes next? I mean, if the tax cuts can basically be extended, and that's basically the assumption in markets, doesn't that kind of tip the scales on the inflation, on the growth side of things that I think equity markets are waking up to?
I think when I look at the taxes getting extended, it seems incredibly likely, right? So I think it's going to increase the deficit, but a lot of that's priced in. I'm not sure that it does a ton for growth. I don't think anyone's been sitting there trying to figure out their expenditures based on higher taxes. I think most people kind of assumed on that. So I don't think you're going to get a big economic boost from the tax cuts, maybe something if it happens on the corporate side. I think that's more just the status quo. But I do think the bond markets got ahead of themselves in terms of worrying about deficit. Inflation, yeah, it could come back. We're seeing elements of that. And I do think we are probably going to see difficulty getting much below 2%, 2.5% even consistently as we try and build onshore refining, right? As we try and do a lot more of this resupply, I think Trump is going to do a very good job. I think one thing that's been lacking in a lot of the last 4 years as we've been trying to move towards sustainable and self-dependence is not in my backyard. Not in my backyard has stopped a lot of projects. And I think that's one area that Trump might do a good job of, is looking at some of these rules and saying, hey, those were important. They were put in place, but they were put in place where we're not really in a global economic competition with China. Now that we are, let's rethink some of these. And I think this time, as the previous guest mentioned, he is surrounding himself with some good advisors who he does seem to listen to.
Given the fact that people do think, and equity markets seem to be suggesting, if not a full throttle growth shock, something that looks a little bit like it, maybe on a tempered scale, there's a real question of what the Fed's response will be to that. And I wonder how much you look at long end yields coming down as part of the consequence of Jay Powell potentially opening the door to not cutting rates again in December.
Yeah, I think Powell handled it very well, and I completely agree with him, right? People got ahead of themselves and, well, what will this policy do? What will it look like? It's going to take months for this to even start playing out. I don't even know what will get done in the next year. I do think a lot of it was a negotiating ploy, and a lot of it will be very difficult to implement. So, yeah, I think Powell held the line, said, hey, we will look at this. We will judge it as it becomes policy. And so bond markets have got way ahead of themselves. I think, again, this has been flip-flopping. Just when we probably should not have been at 370 or 380 a month ago on 10s, we probably should not have been at 440. I think 410, 425 is a good range until we find a little bit more policy definition there and see real signs of inflation.
Peter, can we just go back to China for a moment? As we read the tea leaves coming out of Mar-a-Lago about who's going to get what key position, Robert Lighthizer was a key architect of the aggressive tariffs of Trump 1.0. What would be the difference to markets if he becomes the Treasury Secretary, or potentially he just has a more of a niche trade portfolio within the West Wing?
You know, I think Treasury Secretary is going to be important. I'm not sure that the market would like that. I think they've accepted what he does on trade. I'm not sure that they would take him in that broader response, but that's going to be an interesting, role to fill out. And again, I think there's going to be a lot of, ooh, that's interesting. Ooh, that's a bit scary. And I think that's just something we're going to have to digest. The one thing I've been trying to, say to people, and I'll probably do my weekend note on it is, if only AI had a good way to actually translate what Trump says into what he likely means, and even more importantly, what's likely to go policy. So that would be a great AI app, I think, someone to figure out.
Maybe Elon Musk can. So would Robert Lighthizer be a, ooh, not so good, and maybe Scott Bessent would be like, oh, we can handle that?
I think markets are going to handle it until they see real policy come out, how people respond. Again, I think we're all just digesting, okay, he is now in charge. And we've seen this kind of, circle of people that have surrounded him through the election. I think people have adopted a view that, okay, this circle of people seems much more involved, seems better organized. Now we'll have to individually figure out what that broader circle is going to look like. So I don't think there's going to be any panic. And I would argue, I think, maybe push back a little bit, Lisa, that I don't think it's necessarily we're seeing a growth spurt, but I do think we are seeing people say economic slowdown is likely off the table, right? Trump will work very aggressively, especially with the House and Senate on his side, to ensure that we do not get a bumpy landing. So I think that really is what's being taken off the table this week, more so than just an outright growth opportunity.
So, Peter, do you agree with Mohamed El-Erian, who sees this economy as bigger, but not necessarily hotter?
Yeah, I think it's going to be more broad, right? I think that's one reason you've seen some of the Russell 2000 stocks do well. And again, you're getting a little bit of reversals in all these trades, but I think there really is this opportunity for more domestic growth, for jobs to be created, for industries that maybe, have not been the be all and end all lately to do better. You are seeing rates coming down. A lot of the smaller companies do rely on floating rate financing. So yeah, I do like this trade, and I'm starting to look really closely at commercial real estate. I've been on the teetering about really wanting to highly recommend that. I think that's going to be great. I think you're going to see a lot more work from office mandates coming from companies, and the U.S. government is still actually very much work from home. If you're talking about efficiencies, having a bunch of people not use the office space, that's probably one of the most inefficient things, and that seems like an easy thing to solve, right? Start mandating 3 or 4 days a week back in the office. Government employees, you see DC's commercial real estate do better. So I think commercial real estate is going to be one of the benefits of this. And let's not forget, that's the one thing Donald Trump says he understands is commercial real estate. He loves it. So I see no reason for him not to push policies forward that will help that.
Hey, Pete, that's a great call, because anyone that goes down to Washington, D.C., ghost town. Peter Tchir of Academy Securities. Peter, thank you. And shout out to Peter. Tuesday night, bond markets start selling off. Peter Tchir on Bloomberg TV. I think you should buy bonds here, which was a brave, brave call at the time. DC is a ghost town. You know this well. If someone came out and said, let's get back to work, get back to the office, that would be a big shout.
The businesses and restaurants in Washington, D.C. would be very happy. I will say, when I first moved there, it was still the end of the pandemic. Everyone was working from home. It felt dead. It's gotten a little bit better, but still, a lot of these federal workers work from home. That's not going to fly under Trump 2.0.
All I could say is I actually got a lot of notes about commercial real estate yesterday. If there is anyone that is going to help commercial real estate, it is probably someone who has made his money completely in commercial real estate. And you have to imagine some of the policies that are going to go into place.
Make Washington great again. I think that's...
Is that the goal?
I think that's what his goal is, yeah.
Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Dutch police arrested 62 people after authorities said rioters attacked Israeli supporters following a soccer match. The violence was condemned by the leaders of both the Netherlands and Israel as anti-Semitic. Israel's national airline said that it will offer free rescue flights from Amsterdam to Tel Aviv over the weekend. Argentinian President Javier Milei will meet with U.S. President-elect Donald Trump and Elon Musk next week at Mar-a-Lago. Milei voiced support for Trump after his win on social media. He's tried to forge closer ties with the U.S. since taking office last year. Meanwhile, the Conservative Political Action Conference is set to kick off next week, also at Trump's Beach Club. AstraZeneca is no longer the UK's biggest company by market value after a dismal week. Its market valuation dropped by over $27 billion this week, with ongoing investigations in China over alleged illegal imports of cancer drugs and privacy breaches. That's also on top of another investigation in China over medical insurance fraud. The stock has lost about a quarter of its value since reaching a record high in early September. Now, oil giant Shell has retaken its spot for the UK's largest company. That's your brief. John.
Danny, thank you. More from Danny in 30 minutes. Up next, emerging markets bracing for tariffs.
This is going to be long, and it's going to be messy, and it's going to be inflationary. It's going to be targeted at China, but Mexico is going to take the brunt of it.
That conversation up next. Equity futures up 0.1% on the S&P 500. Bond yields just a little bit lower, down 2 basis points, 430. Under surveillance this morning, emerging markets bracing for tariffs.
It's all going to be about tariffs, and more tariffs here because he can move very quickly. I'm thinking like day one, week one quickly. Be prepared for big-time tariffs that he promised, 10 to 20% across the board. This is going to be long, and it's going to be messy, and it's going to be inflationary. It's going to be targeted at China, but Mexico is going to take the brunt of it.
So here's the latest. Mexico in focus as President Claudia Sheinbaum says she spoke with President-elect Donald Trump about trade relations. Trump's re-election could leave Mexico and other emerging markets looking vulnerable. Dan Tobon of Citi saying President Trump's re-election is dollar positive. We think the dollar could approach the top of the 2-year range on tariff, trade war concerns and relative growth outperformance. Dan joins us now for more. Dan, welcome to the programme. I just want to start with EM quickly and pick up on that line from that last speaker, Heidi Krubo-Rediker, who said those tariffs are going to be targeted at China, but Mexico is going to take the brunt of it. Do you agree with that assessment?
Well, it depends on the timeline, because Mexico under USMCA has some coverage from tariffs. So, and initially we think the more rapid tariffs are the ones that will come under Section 301 and Section 232, which would more likely be very targeted towards China. When Mexico is going to be a little bit more vulnerable is when the USMCA comes up for review in the summer of 2026. So we think if there's an order to this, it's China first for this year, and then Mexico for next year. And that's probably also in line with how we would think about the congressional side of things, right? These broad tariffs, which are being discussed, those probably need congressional approval versus the country-specific targets, which could happen a lot faster. So, I think it's China, then maybe these broad ones, and then Mexico into next year.
So maybe dollar strength, but not necessarily to the moon, not necessarily continuing a trajectory of what we saw in the immediate knee-jerk aftermath of the election. Is that right? I mean, basically, have we seen almost the bulk of the moves already?
Maybe we've seen about half of the moves, we would say. The way that we think about it is, you look at 2016, Trump won, and it was a surprise to the markets, and the dollar rallied around 5%. You look at 2020, the markets thought that Trump had a good chance of winning. They built in some premium for him winning. He didn't, and the dollar fell about 4 to 5%. The question here is how much of this dollar rally that we've seen so far over the last month and change is a function of the elections versus just the relative change in expectations for the Fed versus the ECB, we would say it's probably half and half, which means only about 2% of this rally, of this 4% rally over the last month, is Trump, which means we probably have another 2 to 3% to go to really fully price in all of the potential policy impacts on the dollar.
You talked a lot about how a lot of these tariffs are initially going to be focused on China and that Mexico later on during the USMCA could get hit. Is that the reason why we saw some of the Mexican peso strength in the immediate aftermath of the election, completely defying what everybody was saying as a proxy to the potential Trump win, was selling the peso?
I would say that probably has more to do with positioning. We've seen a very steady weakening of the peso, regardless of anything else going on in markets. And so, the way that these elections work, these are very big, known events. And what you have historically seen is a lot gets priced into the options market and volatility markets in expectation for the event. So dollar MEX volatility, for example, was through the roof, record level highs and an expectation of the move. Well, what happens when you get the event and you don't realize the move? The volatility comes off very, very, very sharply. That actually helps support the risk asset, that the volatility is being placed on, and that allows some positioning readjustment. The real question is, will this continue or not? And it's tough to say. We certainly have some more concerned. Our EM strategists are a little bit more concerned on the MEX side, just because this is still going to be an issue in the coming years. But the carry is also still very attractive, so you probably see some opportunistic buying now that the big event has passed and a lot was priced in.
Dan, in terms of the path to tariffs, why do you think Donald Trump will go to Congress when he can just use Section 232?
Well, for these broader kind of big picture, everyone's getting tariffed, it's a lot easier to do it through Congress. These sections from both 232 and 301 do have some limits as to how easy and how broad you can apply them. So I think it's that's usually the way these things work when you're talking about the much bigger trade deals.
Dan, I'd like your view on what I think might be a harder trade, the euro, because I think the Germans just introduced some two-way risk in the last couple of days. The prospect that we get an election and the winner ultimately introduces some fiscal loosening, maybe some debt issuance out of Germany, just a little bit of stimulus. Maybe I'm getting too excited here, Dan. Just frame it for us. Is there some two-way risk now in the euro?
Maybe a little too excited. Look, I think it's more of an option, right? Like, it's either going to be the same exact outcome where there's not really that much more room for fiscal, or some potential smaller loosening relative to the size of the structural headwinds that Germany's facing. It probably won't be enough fiscal to really move the needle that much. These are some bigger issues that Germany's economies are facing at the moment. Certainly, it would be a good sign. And also what it could mean for Europe. Do we see broader loosening fiscally? That could be something that could start supporting the euro. For now, I think we'll just have to wait and see. The structural weakness story still remains more impactful. And don't forget, when we think about tariffs, Europe's bilateral trade surplus with the U.S. is one of the biggest in the world.
Yeah.
So Europe is one that could actually be hurt the most. And in G10, we have been saying, look, euro is the easier tariff trade in the developed market space, and you actually saw that in election night. Euro was the worst performing currency as it became clear that Trump was going to win in the G10 space.
Dan, it's good to see you, sir. I always get too excited. Yeah. Dan Tobon of Citi. Not usually about Germany, though, and Europe. Usually I'm pretty downbeat about that.
Calm down. Just because they said fiscal, calm down.
Great. I can still go on vacation next year. Coming up next, Mohamed El-Erian of Queen's College, Cambridge, Adam Posen of the Petersen Institute, Stephen Cook of CFR, and former Kansas City Fed President Esther George, the second hour of Bloomberg Surveillance. Up next.
In the near term, the election will have no effects on our policy decisions.
I think the markets are going to be a great barometer for what policy needs to adjust to.
So we need to gain clarity on a number of things. Trade and tariffs will be really important.
The devil will be in the details, I think, both on trade policy and fiscal policy.
They don't know exactly what the policy will be, when policy will change, how it will affect the economy, and that is going to matter.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Redefining the outlook for 2025. Equity futures on the S&P 500 pulling back by 0.1%. That's the S&P. On the Nasdaq 100, just a little bit softer. Through Thursday, all-time highs on the S&P, on the Nasdaq 100, record highs through the week so far, and heading towards the biggest weekly performance of the year so far. That's the equity picture in the bond market. 2-year, 10-year, 30-year. Take a look at the front end. Yields down 2 basis points, just short of 420, 417.44. Listen to the language just slowly starting to creep in to the discourse on Wall Street. PIMCO's Tiffany Wilding, opening the door to a potential pause in December. GSAM's Whitney Watson, the word skip could enter our vocabulary in 2025. Did Chairman Powell tee that up for December?
Last month, traders were pricing in basically a 100% chance of a December rate cut. Now it's maybe 70%. That went down as low as 60%. The market is saying you have opened up the door because what we heard from Jay Powell was we will have enough data and we will see the market's reaction long enough to understand what this move is and whether or not we have to respond to it.
And then fast forward a few months, you get to March. At the March meeting, they should have clarity on whether the Republicans have a trifecta. They may even have some policy to work with, and then they can start thinking about their models and try and model what the future looks like. At the moment, we're still trying to put those pieces of that puzzle together.
That's right. We still don't know the exact margin the Republicans will have if they are able to sweep when it comes to the House. It could be as close as 218 to 217, but Bob Casey of Signum joining us last hour thinks it's going to be more like 219, 220. These are very slim margins. I think if it was any other individual in the White House besides Donald Trump, you would have everyone walking around like they're king of the castle, king of the hill, literally on Capitol Hill. But it looks like they are ready to come in with almost a mandate of what he promised on the campaign trail. But the tax policy is really going to come into focus at the end of next year because that's when TCJA expires.
It's not said and done yet. Still need to work out how big these margins will be, what kind of guardrails we'll see, and whether they'll come from Washington, D.C., or whether the restraining force will come from the bond market itself.
That's the reason why people are focused on bond vigilantes and just how much you could see them come back. One notable thing about yesterday was Jay Powell talked about how inflation was a bit stickier. And Mohamed El-Erian was the person who came out and said, this seems like a single mandate Fed focused on the labor market. And yesterday, I would argue this became a dual mandate Fed once again, really putting emphasis on the CPI report that we get out next week.
Mohamed joins us in just a moment. Joining us on this program for the next 60 minutes, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge, as Wall Street posts its best Fed day of the year. Adam Posen of the Petersen Institute on why he sees rate hikes coming sooner rather than later. And former Kansas City Fed President Esther George on defending Fed independence. We begin this hour with stocks sitting near all-time highs. The S&P 500 approaching 6,000, notching its 49th record so far this year. Equities heading towards their best week of 2024 as Trump takes back the White House and Chairman Powell continues cutting interest rates. Joining us now, Mohamed El-Erian of Queen's College, Cambridge. Mohamed, welcome to the program. I know you watched the news conference, so let's start there. What was your takeaway?
So 3 takeaways, John. One is, as expected in terms of the characterization of policy, a desire to maintain optionality. And then where I really felt for him, John, is not in his response to the questions vis-a-vis the president-elect, where Powell, the lawyer, came out very strongly. It is this sort of muddled view of what is going on and inability to pivot forward. So think of his responses to the question of decomposition of the bond yield. Think of his characterization of real wages. Does he want them higher? Does he want them lower? Think of his characterization of the labor market. And then that key question by Mike McKee when he said, you've looked backwards, what about forward? And Powell ended up talking backwards. And you get very strongly a couple of feelings, certainly I did, where I felt for him. One is he's become totally hostage to data. And two is that he is in this world of the 70s and 80s where once you are away from the extremes of really high inflation or the threat of deflation, that somehow he believed monetary policy can fine-tune outcomes. And we know that if you over-rely on demand management to fine-tune, you end up with all sorts of collateral damage. So I really felt for him, but not for the political reasons that most of the media is covering right now.
So, Mohamed, you've said this a few times, the lack of a strategic underpinning Could you just provide some clarity on what you think that underpinning should be? Given the lack of clarity we have about the so-called trifecta down in Washington, D.C., what policy might look like, the margins they'll work through, to get that clarity for 2025 and really to sit there in December, which I think we all agree is the much harder meeting, to make a decision on interest rates and to provide forecasts?
It shouldn't have been a harder meeting, John. It shouldn't have been a harder meeting because there was great clarity back in July, and you and I talked about this, that it was time to start reducing rates, that he could have done it 25, 25, 25. We were a distance from most estimate of the neutral rate, which is somewhere in the upper threes, I think. And there's a distance to go. And you reduce the restrictiveness of policy. Instead, we got no change in July, 50 in September, then a sense, you know what, 50 was a mistake. We got the 25. And now, as Lisa pointed out, probabilities are changing vis-a-vis December. You know, this is not what policy should be doing. But this is what policy ends up doing when you are excessively data dependent. You have a path towards closer to neutral. You have reasons why you should pursue this. And if the election promises tend to end up to be reality, then you could change your strategic view. But as he rightly said, we don't know how much of this will end up being actual implementation.
His strategic view, Mohamed, seems to be let's cut by 25, as they just did, and then maybe 25 again in December. And then the question really becomes a blank slate. He said that they will have more data to really make that assessment, putting the focus much more on CPI. Do you think it was a mistake for him to reintroduce the emphasis on the Fed's mandate of inflation after basically kicking it to the curb and focusing simply on the employment picture?
Yeah, and it was such a confused discussion. I mean, he was pushed on core inflation 12 months because he had only focused on headline inflation, so the 2.1 versus 2.7. So he got a question, what about the 2.7 that you haven't mentioned? And then we got into the discussion of, is it 12 months? Is it 3 months? Is it 6 months? He himself previously had said, look at the 12 months number. Now we look at the 3 months number, the 6 month number, just like we went through so many definitions of core and super core and everything else. I mean, yes, he added confusion when there's actually little need to add confusion right now on that issue.
So what do you think the Fed should be doing? If ideally, if they were going to have a framework, what framework should they follow? And I say this as Jim Bianco over at Bianco Research says that right now, to cut rates again might be worse than transitory.
So I don't agree with that. I think that we are a distance away from what the neutral rate is. I think that inflationary expectations are relatively anchored, not at 2%, but you know my view that 2% is too low, and certainly now is too low an inflation target for this economy, unless you want to structurally weaken it in a significant manner. They should be on a path of, until we get significant new information on what's ahead, I stress what's ahead, we will be on a path for now of maintaining a 25 basis points cut. And the other thing I have stressed, it is time to get out of this framework they have, this mindset they have, that they're the only game in town. They are not the only game in town. They should leave center stage right now and become more of an observer and wait to see what plays out. But, you know, once you are on center stage, you've been the only game in town for so long, it is really difficult to exit stage left.
So, Mohamed, that's your advice to the policymaker. Is your advice different to a market participant? Because markets, as you know, are anticipatory. The Fed, you've suggested, is overreactionary. So I want to understand from your perspective now what you would say to a market participant, whether they should be pricing in a big positive growth shock that could come with some additional inflation.
So I tell them the direction of travel is clear. More growth, slightly higher inflation, a higher public sector borrowing requirement, and a huge sucking sound where a lot of foreign capital will end up in the US. That is the direction of travel. What you've got to figure out, and it's hard, and that's why we've got a market, is the magnitudes of these things. But I think, John, the direction of travel is clear. The magnitudes are going to become clearer as we get firm indications, not only of what the policy proposals are, but who's going to implement these policies. The appointments are going to be very important going forward.
Couldn't agree more. Do you think this could be a bigger problem for the rest of the world than it will be the United States?
Oh, absolutely. This is a period in which U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons. In the short term, the rest of the world simply cannot build enough pipes around the U.S. They're trying, and they've been doing it, but these pipes are very small compared to the size of the U.S. Over the longer term, you will see more pipes being built around the U.S. at the core of the system.
Mohamed, the journalists yesterday in the press conference get A for effort for trying to get Jay Powell to talk about politics, but he wasn't going anywhere near this. Do you actually have concerns about the independence of the Fed?
So I would have gone even less. I mean, he gave the legal response. This was Jay Powell, the lawyer, coming out in a very strong way. If I had been him, I would have simply said, I'm not going to discuss this issue. I wouldn't have said no. I would simply say I would not have discussed this issue. Saying no opens up a whole new host of things.
Do you think saying no was hostile to the former president, going to be future president?
I think it wouldn't surprise me if it's viewed as hostile. I think what Chair Powell was trying to do is give the legal answer. However, it can be easily viewed as hostile, yes.
Based on your view of the U.S. gaining that sucking sound of capital away from the rest of the world, do you think that sucking sound will also go to finance the deficit in a way that really caps off yields, that doesn't really allow them to rise as high as some people are threatening, such as 5%?
Yes. I mean, so there's two interpretations of why yields came down. One is the market has revisited. The other, which I favor more, is that U.S. bonds relative to the rest of the world became really cheap. And people reallocated away. If you look at what happened to the differentials vis-a-vis the rest of the world, U.S. bonds in relative space. And most of the time, as you know, Lisa, this market solves in relative space in the advanced world. It solves more in absolute space in emerging markets, but in the advanced world, they tend to solve in relative space. And relative to other advanced economies, the U.S. yields were looking very attractive.
Mohamed, it's wonderful to catch up with you, sir. We're lucky to get some time with you. Next time, I'm going to ask you about a vacancy that might come up at the Federal Reserve in a couple of years' time. And we can talk about that another time. Mohamed, appreciate your time. Mohamed El-Erian of Queen's College, Cambridge. I think you know where I was going with that, Bramo.
I think he did too. I think he was like, really glad you didn't ask me about that this time around.
Might be a space at the Federal Reserve, maybe.
2026?
Yeah.
January?
I think there's a man who's not getting extended.
Yeah, I think that's correct. You think that this is I wonder what the mandate is for the person. I think that there are some other candidates.
Jay Powell, I think, will serve out his term, but he is not getting an extension.
Absolutely not. Not based on the last 24 hours. Anyway, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A rapidly growing brush fire in the Los Angeles area is burning out of control. The mountain fire has destroyed homes and triggered evacuations northwest of Malibu. Governor Gavin Newsom declared a state of emergency in the Ventura County. The mountain fire is one of a handful of blazes that sparked in California this week after the outbreak of seasonal Santa Ana winds. Shares of Expedia, those are rising nearly 4% in the pre-market. It reported better than expected gross bookings in the third quarter. Customers booked a total of 97 million nights on Expedia's travel websites. That is a beat of expectations. It also raised its full-year guidance, hinting at a stronger demand into the holiday season. Separately, Expedia announced that its chief financial officer, Julie Whalen, will step down after a successor is appointed early next year. Tesla is now offering a lease option on its Cybertruck. Prices will start at $999 per month for 3 years for customers who put down $7,500 down. The EV maker introduced a lease option after working through the truck's back orders. Last month, Tesla told investors the Cybertruck was the third best-selling model in the U.S. in its last quarter. That's your Bloomberg Brief. John.
Danny, unreal. Appreciate it. We'll catch up with Danny in about 30 minutes again. Up next on the program, a Trump win, clouding the outlook.
We don't know what the policies are, and once we know what they are, we won't have a sense of, when they'll be implemented or all those sorts of things. In the near term, the election will have no effects on our policy decisions.
Not going to talk about it, but then kind of talked about it a little bit. That conversation up next. Equity futures on the S&P 500 down 0.1%. Bond yields a little bit lower, down by a basis point, 431. Under surveillance this morning, a Trump win clouding the outlook.
It's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. In the near term, the election will have no effects on our policy decisions.
So here's the latest. Fed Chair Jay Powell sidestepping questions on how Trump's economic agenda could impact the Fed's dual mandate. Adam Posen of the Petersen Institute warning the following. Almost all of Trump's economic proposals would reduce supplies of labor, industrial inputs, consumer goods and federal tax revenues. This is the exact opposite of the policies aimed at macroeconomic stability that have a proven track record worldwide of bringing sustained growth and low inflation. Adam Posen joins us now for more. Adam, I just want to say up front, I want to congratulate you for having the confidence and conviction to come out ahead of time to talk about these things in a way that I think central bankers are just unwilling to right now. And start there. You said months ago, back in the summer, going into the Jackson Hole speech, what you wanted to hear from the Fed chair, and afterwards you followed up again. You wanted him to engage in scenario analysis. The what if. What if Trump won? What would it mean for policy? And prepare a market and people for two-way risk. Adam, what did you think of what you heard in yesterday's news conference?
Thank you for that, Jonathan, and I appreciate your having me back. I think, look, given where we are now, Powell did basically the right thing. The point was to say it ahead of time before the election, since Harris was going to do tariffs on China and Mexico, not as many as Trump, but tariffs. And since Harris was going to create deficits, not as many as Trump, but deficits, that would have been the time to say, we at the Fed have to look at deficit spending as generally inflationary. We at the Fed have to look at tariffs as potentially inflationary, depending how much it gets passed on. And he could have said that in general terms first. Instead, now that he's here, of course, he can't say anything different than what he said. The big line for me, beyond what you mentioned before the break with Mohamed, was the saying that we don't have a plan, we don't have a commitment from here. So look for more of that. Look for more of them trying to undermine the market's bets of how much cuts there's going to be, but in a non-political way.
Adam, did you think that yesterday was the beginning of that? Was the opening of the door to some sort of pause next month that could really be the beginning of exactly delayed expectations, just pushing it out, pausing for longer as they wait to see what exactly will get put into place?
Yeah, Lisa, I think that's where we're at. I don't think necessarily there's going to be a pause next month. Obviously, I think they'll cut 25, and I don't think they'll fully announce a pause. But I think they'll try to slow it so that they maybe skip January, cut again in February. And by February, you'll know what executive orders the Trump administration has given. You'll know what the budget proposal looks like, in which case, by February, they could be warning that's it for now.
It seems like there's a narrative shift happening right now in markets where it used to be that maybe this Fed would front load cuts in the beginning of 2025. And now you're seeing an increasing number of forecasts saying the Fed will probably cut 25 basis points in December. And then next year will probably pause, certainly for the first half. They won't need to raise rates, but they won't necessarily be able to cut them much beyond 4.25%. Why do you push back? Why do you see such potential still for rate hikes next year?
Well, Lisa, as Jonathan kindly indicated, and you've had me back, we've been talking about this for almost 6 months now. It's, in the end, what doesn't matter who's president, what matters is the policies. If you do large unfunded tax cuts, you tend to get inflation. If you do tariffs on a large scale and on broad, rather than just on a couple countries, you tend to get inflation. If you do things to indicate that maybe the current Fed chair isn't going to resign, and I'm sure he won't, but that the next Fed chair is going to be better terms with the president, that tends to raise inflation expectations. But the other thing is nothing to do with policy, it's economics. The Fed, I think, has overestimated how tight they are already and underestimated the strength of the U.S. economy. And so I think part of the market repricing prior to the election was based on the economics becoming clear.
Adam, when it comes to tariffs, there seems to be a debate on how much Donald Trump can do unilaterally versus what he needs congressional approval for. What do you make of that? I believe if you look at the law of Section 232 and what Commerce is able to indicate to the executive branch, Donald Trump has a lot of leverage when it comes to tariffs on his own.
I completely agree with you, Anne-Marie. I mean, so Senator Rand Paul has put out a proposal to reassert congressional authority, and I think has a legitimate case to make that bill and say this is a tax, and taxes should be voted on by the Congress. But on the current law, there are all kinds of ways. You mentioned Section 232. There are various anti-dumping measures. There's national security measures, all of which Biden either kept in place or used himself, all of which the Congress didn't challenge under Trump or Biden. So unless Senator Paul's bill passes, which I doubt, I hope it does, there's no reason Trump can't just immediately put on tariffs first day. I mean, I'm sure he may not do it literally first day, but I'm sure he's got the executive orders drafted. And legally, politically, precedent, yes, he can do it.
Do you think he is going to use tariffs as a negotiating tactic, or do you think he is going to come out with full blanket 60% on China and 10% on the rest of the world?
I think he is more likely to come out with that than and then try to use it as a negotiating tactic. Look, if you're an honest macro forecaster, which I try to be, sometimes you want to be wrong. You want to be wrong either that you think they're going to do a certain policy, they don't do it, or that the policy has different, better effects than you think. So it is possible that Trump just threatens and waits to see what he gets from people, and he doesn't actually put up the tariffs. As I've argued, I don't think that's going to work because I think he has to be credible both to his domestic politics, but more importantly to his negotiating partners. But okay, maybe he won't. Maybe he'll get it all without threats. More interesting is the question, which some of the people speaking for the Trump campaign who will presumably be in the administration have said is, look, the tariffs can be removed or they can be escalated and the countries will cave, and when they cave, we'll get benefits. And again, that's where I hope I'm wrong. I don't think that's going to work, not so much because the countries won't cave, but once the tariffs are in, you're not going to get the results you want and you're not going to remove them. So, but I hope I'm wrong.
As we've seen with the current administration, who didn't remove hardly any of them. Adam, it's good to catch up, sir. It's good to see you. We appreciate your time, as always. Adam Posen at the Petersen Institute, with a whole range of things to think about. I think the guiding light for a lot of us right now is just to wait for the cabinet positions. And that if you see the likes of a Scott Bessent in the Treasury position, who's been on this programme and talked about using it as a negotiating tactic, I think it would give more weight to that argument, at least in the near term.
2.5% for 24 months. Xi Jinping tells when it starts to bite. Personnel is policy. That is why reading the tea leaves out of Mar-a-Lago is very important right now to the financial markets.
Coming up on the programme, we'll catch up with Stephen Kirk of the Council on Foreign Relations as world leaders react to Donald Trump's win. Three-day winning streak on the S&P 500, the longest winning streak going back to September. Just pulling back a touch this Friday morning. We're down by 0.1%. On the Nasdaq 100, we're down by around about a quarter. In the bond market, 2-year, 10-year, 30-year. 10-year yields actually down on the week. We're down another basis point this morning, 4.31. On a 2-year, 4.1870. Down a single basis point, with plenty of healthy debate around this table in the last 12 hours or so about the future of Fed policy and whether we could get a pause in December.
Either way, they clearly put inflation back on their bingo card, and CPI is going to be really interesting. When we take a look at the moves in the market this week, what stands out to me is what Mohamed El-Erian was talking about, that sucking sound of foreign capital into the United States. And yes, it will go into equities, but it will also go into bonds with a differential as wide as it is with the rest of the world. And that's what we saw with flows this week, as well as yields.
So the follow-up to Mohamed that we really need to get into next time is where the money is coming from. Where's it being sucked away from? At a time where the UK is going to issue more debt, when Germany is going to put bond supply on the ballot effectively. Where does that money come from? Do they have that fiscal space if they want to counter some of the policies that we're seeing take place in the United States?
What we saw from Germany is when there was the dismissal of the finance minister and the suggestion that maybe this opened the door to loosening the fiscal purse strings, a question mark about whether anyone would finance it, yields rose. And that you didn't see that knee-jerk response in the same kind of way in the United States. And it raises this question, do they have that much less room to do so because there is so much money flowing to the United States?
There is a belief that a Trump presidency is bullish for stocks, it is bearish for bonds, and it is bullish for the US dollar. The US dollar on the week so far, just about positive. We're looking at 6 consecutive weeks of gains potentially on the US dollar. 6 weeks of strength. The longest weekly streak going back to September 2023. Euro dollar, 107.69. Under surveillance this morning, full control of Congress, hanging in the balance. According to the AP, Republicans nearing a majority in the House with 211 to 199. 25 races have yet to be called. The GOP securing control of the Senate 53 to 45, with 2 races yet to be called. That race for the House is the big one.
This is the big one because this will determine whether or not they have the trifecta. I go back to what Punchbowl has this morning, speaking to House Majority Whip Tom Emmer. I don't care if it's 218, 219, 220. I don't give a damn as long as we have the majority. But then Jake Sherman points out the fact that that means 0 room for error. Absences, illnesses. Do you want to take Representative Elise Stefanik from a New York district and maybe put her at the United Nations? How difficult will that be if you have no wiggle room and you don't want to run special elections and you want to hit the ground running when it comes to immigration and tax policy?
What did you make of Signum's take on this? That ultimately, you said, is everyone going to be a king? And he said, no, there's going to be one king and they're going to do everything top down and they'll just follow their leader. Do you see it the same way?
I think it's somewhere in the middle. I do think it's somewhere in the middle. I don't know if you're going to have 218 Joe Manchins walking around the lower chamber of the House of Representatives, but Donald Trump is going to feel like, I mean, rightly so, when you look at the direction of travel of the United States and how the votes came in, he's going to feel like he has a mandate. And he thinks that that's going to have to trickle down to individuals. We also know how he feels about people having, personal loyalty to the head of the party. So I understand where Casey's coming from, Bob Casey there of Signum. At the same time, there's going to be certain districts, maybe they're a Republican rep in a district that Kamala Harris won, and they're gonna need to push back a little bit.
To that point, French Hill's comments on the deficit were interesting to me yesterday. And there's a question of what mandate, especially if certain people try to impose some fiscal discipline.
Guardrails. Do they come from the market or do they come from the lower chamber? We'll see. China looking to boost its economy ahead of a second term for Donald Trump. Authorities announcing $1.4 trillion program to support local governments and refinance debt. The plan allowing local governments to issue more bonds and save on interest in the coming years. This is smaller than some people had hoped for. Is that fair to say?
I think that's fair to say. I also think there are people saying, are they going to provide direct stimulus to individuals, to consumers who can go out there to spend? Are they going to build another bridge to nowhere, albeit not necessary, but maybe that could help industrial growth? Are they going to necessarily support housing prices? You can refinance debt and save 600 trillion yuan on what we see with respect to interest payments. It underwhelmed expectations. And it raises the question, was this what they were hoping for? And do they have the capacity to stimulate on the levels that some people were hoping for, given that everyone said they were waiting to see whether Trump got back in the office? Well, they saw what happened. And this is what they came up with.
Right. But is the policy going to be, to Adam Posen's point, is it going to be blanket tariffs or is it going to be a negotiating tactic? Maybe that's why it underwhelms. They actually want to see what Trump does in the first 100 days.
Everyone's thinking the same thing. What about Nippon Steel? You're not thinking that, but let's talk about it.
I am.
Saying it expects to complete a $14.1 billion takeover of U.S. Steel by year end. The deal continues to face opposition from unions and the outgoing Biden administration. President-elect Donald Trump repeatedly pledging to block the deal on the campaign trail. Where does that confidence come from?
I'm thinking about this because I spoke to a source about Nippon Steel last night. It's been hanging out in political purgatory in CFIUS. CFIUS has been used for, I think many would agree, blanket political reasons because of Pennsylvania and their 19 electoral votes. Now that the election is over, Biden is a lame duck president. It looks like it's going to be a Republican trifecta. He could potentially allow this through. My advice to Japanese leaders and the union would be to make a quick trip to Palm Beach and get the incoming president's approval as well for this deal if he wanted to go through. But it was hanging out in political purgatory, and those conversations are going to start as of last night.
I just want to pick up on what you said. If this was political purgatory, now that the political purgatory is over, Joe Biden maybe not be as opposed to it as previously thought. Maybe CFIUS will realize it's not a public security concern, and that is what I'm actually very curious to see.
Did you notice the energy that Joe Biden has yesterday, President Biden?
Not
Just
yet.
a little bit of a skip.
Pep in a step.
I saw all the memes. I saw them. I saw that they were saying now
Ramo,
he's energy.
the media has got to call it as they see it. It's a mistake they've made for the last several years with this presidency.
He seemed cogent and energetic.
Thank you. Some energy. Where did it come from? I don't know.
I think President Biden might think, and this is just speculation, some conversations I've had, I think he thinks maybe he'd perform better, especially in places that Donald Trump won in Pennsylvania. At this moment, history will tell, he's the only individual who is able to beat Donald J. Trump.
What happened this summer, that weekend? Someone's still got to write the book, and I'm looking forward to reading it. What happened that weekend at the beach house in Delaware? Who pushed him to step down? Who wrote that letter?
Well, let's think about who President Biden has yet to speak to since he dropped out. I don't believe him and former Speaker Nancy Pelosi have yet to have a conversation.
It's a book to buy this Christmas, potentially. Or maybe not, or maybe next Christmas. Let's turn to foreign policy. World leaders preparing for Donald Trump's second term. Israeli Prime Minister Benjamin Netanyahu reacting enthusiastically to Trump's re-election. Both Vladimir Putin and Volodymyr Zelensky congratulating Trump, but Putin giving no indication he's ready to make concessions to end the war in Ukraine. Joining us now is Stephen Kirk of the Council on Foreign Relations. Stephen, welcome to the programme. Just first of all, let's start in the Middle East. What do you think changes with the election of Donald Trump?
Well, let me just say that the Middle East is the one region of the world right now where most leaders are very, very happy. I think with perhaps the exception of the Iranians, all of the leaders were quick to call Donald Trump and issue him the warmest congratulations for his overwhelming victory. I think what changes mostly is that, the head of the State Department transition, a guy named Brian Hook, said it yesterday, that almost assuredly the Trump administration would tighten sanctions on the Iranians. Maximum pressure is going to be back. The Biden administration has allowed the Iranians to sell a lot of oil on the market to keep gas prices low for Americans in this election cycle. Donald Trump and his team are looking to put that pressure back on the Iranians. When it comes to the war in Gaza, the president-elect has been vocal in telling the Israeli prime minister that he should wrap things up by Inauguration Day. I'm not quite convinced that that's going to happen, but I think the difference here is that the Trump administration will allow the Israelis even more leeway to pursue military operations as they see fit to bring this conflict, this terrible conflict, to an end sooner rather than later. And that may include, I think it likely will include, releasing weapons that the Biden administration has held back from the Israelis.
Stephen, regardless of what happens with Israel, do you think that a Trump 2.0 is going to push almost immediately for an expansion of the Abraham Accords?
Well, since the Abraham Accords were President Trump's signature foreign policy achievement during his first term, I think it's likely that Trump will go back to the Saudis and say, let's talk about normalization. The Saudis remain interested in it. Their price has gone up as a result of the conflict in the Gaza Strip, but they see it as a strategic choice to normalize with Israel and integrate the region. The obstacles to this, of course, are if the Saudis continue to say that a two-state solution is a requirement, something they were not saying prior to October 7th. But nevertheless, this is going to be something that the Saudis and the United States are going to be involved in. And since President Trump has kind of a unique relationship with the Saudi leadership, he may very well get somewhere.
So, but as to your understanding right now, Israel, the war in Gaza would need to be settled, and then, I mean, in terms of the timeline, and then he can move for potentially opening up that kind of peace deal between Israel and Saudi Arabia.
There's lots of things that they can do short of normalization and short of the Saudi requirement, which was encouraged, by the way, by the Biden administration. But yes, I think they will negotiate this. They will push this. They may make some progress, but I'm not confident that we'll see a normalization agreement soon.
Expanding outside the Middle East, how quickly do you think Donald Trump will get on the phone with Vladimir Putin?
I think that this is something that's going to happen relatively quickly. I think the president ran in part on being able to settle these conflicts around the world. And his base does not like and the Republican Party does not like the support for Ukraine. And so I think the president, who sees himself as a master deal maker, is likely to get involved in this negotiation relatively quickly. This is obviously making the Europeans very, very nervous. But nevertheless, this is going to be the policy of the United States, is to pull back from the support for Ukraine. And you can tell that this is going to be the policy because the Biden administration is scrambling to lock in a variety of ways of supporting Ukraine between now and Inauguration Day, I should say.
Stephen, do we have any sense of what that deal looks like between Russia and Ukraine that Donald Trump would like to orchestrate?
It's very unclear, but I think that we've seen some people in Trump world talk about a sort of stand in place, acknowledge the fact that the Russians control parts of Ukraine and negotiate from there. I think that there is a view that the Ukrainians are never going to regain that territory. And so therefore, let's negotiate new lines. But it remains to be seen whether Vladimir Putin is emboldened by Donald Trump's election. And it's possible he won't agree to that.
There's a larger question, too, Stephen. You said that this is making Europeans very nervous, that Donald Trump is opposed to providing the same level of support from the United States for Ukraine. At the same time, you've seen European pushback as well among the public against some of the funding that officials have put into place. Is there a movement taking place on the ground that sort of also is pushing these two countries together?
Yeah, look, it strikes me that the effort in Ukraine is something that is important for NATO and NATO cohesion. And Donald Trump is skeptical of it. The American public is obviously skeptical of it. European publics are increasingly skeptical of support for Ukraine. But the Europeans, of course, have a lot more to lose than Americans. There's going to be a tremendous pressure on European governments to do something about Putin. The eastern flank of NATO is, in fact, exposed if the United States ratchets back or ends its support for Ukraine. I'll point out that Donald Trump has said that he would pull the United States out of NATO. So, of course, that's something that you might say during an election campaign or not. It may or may not be policy, but there are likely to be changes happening in Europe, and those are going to have political reverberations in Europe as well.
Stephen, it is worth noting the new leadership at NATO. The Secretary General, Marc Rutte, the former Dutch Prime Minister, has been on the programme with us and said live on TV that the former president, now president-elect, was right about what he said about NATO. Do you have any fears about a relationship being soured there? Because at the moment, on the surface, it looks like there could actually be a pretty decent one.
Yeah, look, President Trump takes a tremendous amount of criticism for his relationship with Europe during his first term, but he did spur NATO allies to spend more on their defense. NATO has ramped up its spending and its defense production, so that is an overall good thing. The question is what President Trump is likely to do early in his term. Is he going to follow through on the promise that he would take the United States out of NATO on day one? What is the policy? And we really don't know. And I think in your previous segment, you talked about who's showing up at Mar-a-Lago, who's doing what is a telltale sign of this. One heartening thing on this issue is that the person who's running the State Department transition is not someone who's likely to recommend the United States leave NATO. But of course, the only policymaker really here is President Trump.
Stephen Cook, appreciate your time, sir. As always, Stephen Cook there of the Council on Foreign Relations. With an update on news elsewhere with your Bloomberg Brief, it's Danny Berger.
Hey, John, Rivian shares are basically unchanged, slightly lower. It said that it was on track to achieve a gross profit in the last 3 months of the year. The EV maker is counting on a surge of regulatory credit sales after production disruptions added to losses. Despite maintaining its forecast, Rivian's third quarter earnings missed Wall Street expectations. Now, Paramount Global reported big gains in streaming subscribers in the third quarter, shares up 2% pre-market. Overall sales, though, at the parent of CBS, MTV, and its namesake Hollywood Movie Studio were weaker than expected due to declines in TV and film revenue. Paramount is working to close its merger with Skydance Media in the first half of 2025. The deal would see producer David Ellison take over the company. Richemont shares, those are plunging 4.1% in the European trade. The Cartier owner reported a profit slump in the first half of the year. Its watchmaking division faced falling demand in China. Sales were stable, but operating profit booked a 12% drop. Other luxury brands like LVMH and Kering have also felt the pressure from weak consumer demand in China. And that's your brief. John.
Danny, thank you. Up next on the program, Fed independence.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
No. That conversation up next. Not that one, because that's not very long. A much longer one. Live from New York City, welcome to the program. Under surveillance this morning, Fed independence.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
So here's the latest this morning. Fed Chair Jay Powell dismissing the idea of stepping down if Donald Trump asked. The president-elect has a history of publicly criticizing the Fed chair and recently called it the easiest job in Washington.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god.
Let's talk to one of those gods, the former Kansas City Fed President Esther George. Esther, welcome to the program. It's so wonderful to hear from you once again. How difficult is life about to get at the Federal Reserve?
Well, it's never an easy path when you get to a time like this. But remember, Jonathan, this institution was by design anticipating that there would be political influences on it. And so a lot of safeguards were put around it to allow the individuals that sit around that table to really maintain their focus on the American public and the mandate that was given to it by Congress.
There is a confusion, though, Esther, given the fact that a lot of the potential proposals would have a fundamental effect on the trajectory of the economy, and that's certainly what the market seemed to be responding to. Do you think, if you were on the Fed, you'd be rethinking just how much further the Fed can cut?
Well, there's no question, Lisa, that you have to take into account fiscal policies and the impact they can have on the economy. And of course, when you're making a forecast, you have to be thinking about what are the risks around that forecast. Whatever baseline you set, you have to be thinking about what lies ahead in terms of setting a path. And I thought yesterday, the chairman was pretty clear that he wasn't going to offer any forward guidance about what comes next. And I think that's really the right way to handle it at this stage.
At this stage, December isn't going to be so easy because they do have to release a new statement of economic projections. I'm sure that you are very glad that you don't have to offer up yours. How do they signal a potential scenario analysis around something that the market is actively considering and responding to?
So I think where we will see that, certainly you could see it play out in the median assessment of those 19 forecasts. But you'll also see it in the statement where this committee will talk about the balance of risk, and they will talk about their own assessment of what the path ahead might look like. Today, they're relying on what they know, which is we have the economy that's handed to us. We are saying risks are roughly in balance. You heard the chairman say several times what the trade-offs are between going too fast versus too slow. And so it will be a while before they get any clarity on what steps will be taken in Congress, in the administration, that will begin to bend the curve of those forecasts.
Esther, can we rewind and play the tape back? Because you've lived this. You lived the tax cuts in 17 and you lived the trade war in 18. And we're asking the same questions of people now that we were asking at the back end of 16 when President Trump was elected to his first term. Could you share with our audience your experience in that, at that time, how long things took to really start to consider what was happening on the other side of Washington?
So there's the real challenge for the committee when you are watching how fiscal policy might play out. So you can see today, for example, if you're thinking about tax cuts, as we were back in 2017, at what point do those feed through the economy? When do you feel their full impact? And importantly, what else is going on that is going to counter whatever you might estimate those effects to be? So it is really a process, as it was when I was at the table, of saying, what are the various scenarios? Where might we see more immediate impact? And then what tends to play out over a longer time frame? Also taking into account other things going on in this very large and complex economy that we're trying to make an assessment of.
Esther, that final point I think is the more important one. The tariffs back in 18 didn't turn out to be as inflationary as some people warned. Is there reason to believe that given the backdrop now, given the current context for things, that it could be more inflationary this time around?
Well, I think by the Fed's own admission, there are upside risks to inflation right now. Inflation has not returned to target, even as it has come down. We are looking at a fiscal situation that is likely to bring upside risk here. We're looking at really global trade and changes and shifts there. So many aspects of what we see playing out today, I think, give good reason to be cautious, to think about those upside risks, even as you watch any given action taken that could be pro-inflationary.
Esther George, thank you for sharing your experience with us this morning. We appreciate it, as always. The former Kansas City Fed president there, Esther George, on the introduction of two-way risk in 2025 in a more material way in the last few days.
And her point that this is a different circumstance. You have to look at the economy that you have. And one thing that Adam Posen said that he thinks that this Fed has been missing is that the economy actually had more inflationary momentum heading into this period of time than they currently have been talking about.
Similar to the view of Torsten Slok of Apollo.
Correct.
I just wonder how quickly before we're talking about rate hikes in 2025. Got to see what the policy is, got to see what the margins are, see if we even get a trifecta first. Let's get through the week. It's a lot to figure out. Up next, Jim Bianco of Bianco Research, Ryan Petersen of Flexport, Marc Giannoni of Barclays and Subadra Rajappa of SocGen.
Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point.
They're kind of on an autopilot to get rates down to around 4% in the early part of next year, and then we take it from there.
You've got to preserve the economy in some sort of steady state. We're too high right now.
As you get into next year, listen, I mean, you got what could be a pretty significant policy changes.
I think Jay Powell will want to preserve optionality for 2025. A lot can happen.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Can we fast forward to Thanksgiving? Don't you just want to skip the next few weeks?
You just want to skip
Start the holidays.
break. Yeah, because I have a day off. That's exactly what you're saying.
You know what's happening at my house soon?
What's
might
that?
happen this weekend.
Oh, the Christmas tree? Oh,
no,
my
that
goodness.
might happen. Getting
Come
closer.
on. It is not closer. It's not even November 10th.
It's
Give me a
mid-November
break.
this weekend.
Bloomingdale's already playing the Christmas music.
Trees ready to go.
Yeah, you're really getting in the
Decorations
spirit.
ready to go.
Love it.
I'm in the spirit. Stocks are at record highs. Trees going up, lights are coming on, music's going to start playing. Equity futures down by just 0.05%. On the Nasdaq 100, we're down by 0.2%. In the bond market, 2-year, 10-year, 30-year, 10s at about 430, way off the highs of this week. We got very close to 450, and then Lisa backed away.
A real question here about how much is some sort of overplaying of expectations and how much is real. I think that this really put it well, this one economist saying there's a sense that even the most exuberant Trump trade investors are taking a step back to think, at this point, are the bets overdone? I think the conclusion in equity markets is, probably not. That's what we're hearing. In bond markets, people are saying, just hold on a second. Let's see exactly what these policies are.
Let's see exactly what the makeup of the House of Representatives is. It might be 218 to 217. It looks like they're on course. They are poised for this trifecta, but they're not going to have a ton of wiggle room. Absentees, people not being there, this could become very challenging. And then, of course, you have to think, what do they actually want to fight about? What do they want to get through first? Is it going to be immigration, which it feels like a lot of individuals, when you look at exit polls, went out and voted on that? Or is it going to be tax policy? And the former president basically threw every potential tax cut at the wall. Which ones actually stick?
Two very different scenarios. They might fall short. I mean, the great assumption right now is that they won't. I think there is high conviction that they will get a majority in the House, a very small margin, but we're not there yet.
It seems like when you talk to stock investors, they're saying even if there isn't some big mandate, just the extension of the tax cuts, the lack of this sort of risk, this event risk hanging over the landscape, and given the incredible earnings that we've gotten, earning beats across the board, people are able to bet on that again and less necessarily on the uncertainty. And this has less to do with some of the proposals that could come down the pipe.
I will say, I think one risk was taken off the table last night, and that was Susie Wiles, respected inside-outside Trump campaign. She is going to be a human moat, is what I'm going to call her, around the future President-elect Donald J. Trump, because she's going to make sure voices that really are not in line with the agenda that she was running from behind, the backbone of that campaign, they are not going to be in the West Wing.
We are all looking for policy signals. And within the tea leaves, I think the guiding light right now is to look for the cabinet positions as that starts to come together through the next few months. So one to watch. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research on a Fed policy mistake, Ryan Petersen of Flexport on the impacts of Trump's trade policy, and Marc Giannoni of Barclays on why a December rate cut is not guaranteed. We begin this hour with equities near all-time highs following Trump's election win and Chair Powell's latest rate cut. Jim Bianco of Bianco Research saying, I'm a no-lander. The Bloomberg Surprise Index is at its highest level since February. Now we have fiscal stimulus in the form of tax cuts and deregulation. The Fed is overstimulating and setting up inflation problems in 2025. Cutting rates now, wait for this, cutting rates now might be worse than transitory. Jim joins us now for more. Jim Bianco, that's some punchy stuff right there. Let's build on it. Are you talking rate hikes in 25?
You know, I don't know yet if we're going to need rate hikes. It depends on how many more rate cuts we're going to have. If you look at the market is pricing in about 3 more rate cuts. Well, if we get one in December, because it's got a better than 50% chance, I don't know if everybody's ready for the idea that by the end of the year, this whole rate cutting campaign will be mostly done, if not completely done. If the Fed does want to follow through on the Austin Goolsbee line, that they have hundreds of basis points to go to get to neutral, then they might overdo it and we'll need rate hikes in 2025.
Jim, considering we're also talking about the potential for a positive growth shock, is that a world in which stocks continue to do well?
Yeah, well, there's only really one thing that's going to stop stocks from going up, and that is the prospects of inflation, overstimulating and creating inflation. Look, if we have no inflation, and if inflation is defeated, as a lot of people say, then why didn't the Fed cut rates to 0 yesterday? What's to stop them from becoming massively stimulative? The idea is that if you create inflation. And the only thing that stops you once you get inflation is the bond market. Yields will go up so much, it will then stop the rally. And so, you know, that's what I think is going to have to be the big fear in 25. Because right now, with all the stimulus we're talking about, both fiscal and monetary stimulus and deregulation, there's nothing to really stop this market unless we get inflation and we get high interest rates.
Jim, yesterday the message from markets seemed to be that just even the prospect of the Federal Reserve not cutting by 25 basis points next month would be enough to tame inflation, sufficient to really ignite that rally in the long end of the yield curve. Do you think that the bond markets are getting it wrong?
I don't think they're getting it wrong. I think what it is that we're talking on, election and Fed week. We're talking about a week where the MOVE index, which is like the VIX of the bond market, had a 13-month high at the beginning of the week. we were coming into the week with all of these volatility measures saying that an average day is about a 15 basis point move in the 10-year yield, which is enormous. So we're kind of overreading a lot of the volatility that we've been getting this week with whether or not the trends have been changing. But if you step back and you look at the bigger picture, the uptrend in yields that started with the Fed cut in mid-September, I think is very much intact.
What are you looking for to understand truly the amount of inflation that could be in the system currently, as we heard from Adam Posen, as well as what could really get ignited with the extension of tax cuts and potentially other stimulative measures?
Well, I think, as far as inflation, let's remember what 75% of the average basket is. It's in services. And that's why, I'll come back to Powell's, super core measure of, services less housing core less housing services as actually being a fairly good measure, because what it's trying to measure is wage inflation, and it's over 4%. And if we continue to see that kind of measure of wage inflation, I think you're going to start to see inflation move up. Yes, you throw in the potential of tariffs. Tariffs are another form of inflation because they increase import prices. And then you've got the stage set that you could see the inflation rate, which, by the way, seems to have been, I'll use CPI, or core CPI, bottoming around 3% right now. It stopped going down. And then if it does really start doing that and start going up, you could start looking at this idea that we're not in a 2% world, we're in a 3% world, and that should be unacceptable for the Federal Reserve, and they should not be cutting in that type of environment.
Jim, do you think the immediate inflationary impulse will come from tariffs or tax cuts?
Oh, I think it'll probably come from tax cuts, the making permanent the corporate tax rate, and I think it'll also come from some moves on deregulation. Tariffs is a difficult one. I mean, everybody asks me about it, and they're about 50-50. 50% of the people that I talk to about it think tariffs are going to happen, and the other 50% think it's a gambit just to get a deal in place threatening tariffs. And so whether or not we get them is still an open question. I happen to be more in the gambit side of it, that he's threatening tariffs to get some kind of a deal, and that we actually won't see as many.
Do you think the market is over their skis, though, given the fact that we don't know what the margin is going to be in the House of Representatives?
Yeah, it could very well be. I mean, there is an assumption that the stimulus that we're going to get, the fiscal stimulus from the Trump campaign or from the Trump administration, is going to not see many roadblocks. And one big roadblock, especially when it comes to tax policy, could be whether or not we get any kind of a red wave that extends to the House, and extends the House by more than like one seat, because one seat can always, throw any kind of legislation into order. So maybe it's getting a little over its skis right now, but, it's really hard to argue with the market the way it's been rallying.
Jim, we've been playing a game throughout the week with every cross-asset strategist, which is how high do bond yields have to go before equity investors care? And we've gotten a range of different answers. Some people say 4.5%. Other people say that's a silly question because it really depends on the circumstance that we're looking at. Do you have a sense of what would make this equity market really watch the bond vigilantes much more closely? Do you have a sense of what it would take at a time where it seems like stock traders are unfazed by everything?
Yes, and you're not going to like my answer because it's 425 and we're already above it and we're already at that level. Now, wait a minute. The stock market's at a new all-time high.
Correct.
Again, that comes back to what you're seeing in this market is the emotional reaction of the election and the unleashing of potential fiscal stimulus. So it doesn't matter if bond yields were 525 this week, the stock market was going to go up. But I think once we get past this period, we're going to start to see that these yields right here at this level, and if they continue to move higher, is going to be a headwind for the stock market. Why do I say that? Because go back before Monday. What was the stock market doing in the 3 weeks going into Monday? It was struggling. And why was it struggling? Because yields were above 425. And so I think we're there right now. We're just kind of sidetracked with the euphoria of massive fiscal stimulus coming. And once that wears off, if these yields stay at these levels to go higher, it's going to be problematic.
This is a really interesting point, especially if you look at the areas that have outperformed in the equity markets, which is small caps. And traditionally, small caps are more leveraged to yields that are higher. They tend to do worse. Are you expecting that trade to be a head fake and essentially for the yield space to really reassert itself over smaller, more leveraged companies?
I think over time it will. I think what you're seeing in small caps is that's another way of saying value stocks, because everybody's been running towards value in this last couple of days with the idea that fiscal stimulus just means earnings. It means people are going to show up at your store and buy your products or your services. And that's what's got everybody kind of rushing towards those kind of companies. And so I do think, yes, once we get past this euphoria, it might be somewhat analogous to what we saw in China last month when they started all the fiscal stimulus and their stock market rocketed higher for 2 weeks. And then that was it. And it's really been kind of meandering sideways to maybe slightly lower. So yeah, we're in the rocketing part for our stock market right now. It might not be done with, but then we'll go into that phase with, okay, we priced it all in, and now we're going to have to sit there and wait to see if any of this stimulus materializes. And then in the meantime, if interest rates are staying at these levels or going higher, it'll start to weigh on it.
Jim, you're one of the best. Always thought-provoking. It's good to hear from you. The super thoughtful Jim Bianco there of Bianco Research. Andrew Honhorst of Citi just publishes, rate cuts are still coming. We continue to think markets are underestimating the softening of the labour market as well as the dovishness of the Fed's reaction function. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has picked his chief of staff. Susie Wiles, one of the top architects of his presidential campaign, will take on the key role in his second administration. Trump says that she helped him achieve one of the greatest political victories in American history, and she will be the first female White House chief of staff. San Francisco is set to elect Levi Strauss heir Daniel Lurie as the city's next mayor. Lurie won the election with around 56% of the vote, with the incumbent, London Breed, conceding the race. His election is seen as a sign of the residents' dissatisfaction with the status quo in San Francisco. Lurie, who spent $8 million of his own money to fund his campaign, has vowed to tackle issues like homelessness, crime, and corruption. The Baltimore Ravens beat the Cincinnati Bengals in a thrilling comeback win on Thursday Night Football. After trailing 21-7 at the half, Ravens QB Lamar Jackson led a furious comeback with 2 huge touchdowns, both over 65 yards long, and he stayed hot in the fourth quarter to put the Ravens up by 7. The Bengals managed to storm back for a touchdown in the final minute, but they decided to go for 2 instead of playing for overtime and missed the 2-point conversion. That's your brief. John.
Danny, thanks for the update. You'll hear from Danny again in about 30 minutes. Up next, the morning calls, plus Ryan Petersen of Flexport on the outlook for Trump trade policy. That conversation just around the corner. Equity futures right now negative by 0.07%. Yields a little bit lower, down 2 basis points. The 10-year 430.62. Time now for some morning calls. First up, Telsey upgrading Home Depot to outperform, expecting Fed rate cuts to boost shares. That stock is up by 0.9. Next up, Barclays raising its price target on Expedia to 153, citing better than expected third quarter bookings despite a drag from inclement weather. The stock is up by 3.4%. And finally, Citi upgrading Bank of America to buy, saying it could benefit from lighter regulation under the new Trump administration. That stock is up by another 1% in the pre-market. It's already higher this week by 7 percentage points. Turning to trade, President-elect Donald Trump proposing 60% tariffs on products from China and between 10 and 20% on all foreign goods, resulting in more questions than answers about how his administration will implement them and how fast. Joining us now is Ryan Petersen of Flexport. Ryan, welcome to the program, sir. Let's start with this. How busy are you right now? And has business increased a ton over the last few weeks?
Yeah, well, not just necessarily because of the possibility of a Trump election, but we also have a looming port strike on the East Coast. Remember, they went on strike last month, but they got a 90-day hiatus, and January 15th, that contract ends. So all the East Coast ports, right before Trump gets elected, may go back on strike. And so a lot of people are trying to get goods in before that might happen. So there's always something in global trade.
Joe Biden was called Union Joe. How do you think the port negotiations will go under President-elect Trump?
Yeah, it's a really big question. It's sort of like who he listens to, because he himself says back in October made statements in favor of the union and saying, hey, they need the right to negotiate against these foreign companies. At the same time, his main advisor now, Elon Musk, has said, that the union's demands for no automation are ridiculous and need to be stopped. So it's a really big open question. Who's Trump going to listen to, and how does that play out?
Because of that dynamic, do you think these talks could really drag on, and how long could we see them dragging into 2025?
Well, that's one big concern. Is sort of the talks are happening 5 days before the inauguration, and so what's the current Biden administration's role, and how committed are they to making that happen? And then that's of course with the backdrop of tariffs, which you were also alluding to here in your intros. Trump's going to want to come in and have that priority, but it's very hard to govern when there's always something coming at you, right?
Ryan, just to zoom out a little bit, there is this question. You mentioned that things are getting very busy. A lot of people are front loading some of their orders to get ahead of both whatever policy changes might come, as well as that potential strike. Can you give us some sense, some scope of just how much busier it is, how much rates are able to go up for you as people do try to get ahead of that uncertainty?
Yeah, I mean, you're seeing volumes they're a little bit higher, but it's very hard to attribute to any one thing in this. It's a very complex, dynamic world. So I wouldn't want to say, oh, the volumes are up this much because of tariffs or because of looming changes in policy. So I don't have a specific number to tie to it. That said, we've seen it every time. Whenever there's new tariffs, you see a big surge. You saw it with the Biden administration earlier this year when they increased Section 301 tariffs on Chinese steel, for example. That led to a big push, and ocean freight rates went up about 3x earlier this year. From long-run historical average, it costs about $2,000 to ship a container from Asia to the U.S. That went up to over $6,000, $7,000 in the spot market this summer, and it was driven by that. It was driven by people pulling goods in both before the port strike and before the tariff. So we've seen this movie before, and we're probably heading right back into something similar.
I'd like to lead into this idea that we've seen this movie before. We've had the experience of the 2018 different tariffs that came to play, 2017, 2018. There's a real question about how much companies have already rejiggered their supply chains to adjust to a new reality, new pressures, a new focus on nearshoring and onshoring. How much have you seen a real shift in the patterns of your clients in terms of where they ship from?
No, it's been massive over the last decade, and not just driven by the tariffs, although that's a big factor, but also driven by labor costs. Chinese labor costs have gone up. It's good for the workers in China. They're getting paid more, but they're no longer the low-cost source of labor for the world. And so companies have been relocating. Companies that can have been relocating, especially to Vietnam, India, Mexico have been sort of like three big winners, but many other countries too. And that said, there are a lot of supply chains where you just can't get it done outside of China. The manufacturing expertise, the ecosystem of component suppliers. And for that, I'm specifically talking about electronics. There are a few other sectors, but really the electronic sector has a real hard time moving manufacturing out of China. And then the other big factor, the other big industry here is e-commerce. Chinese e-commerce parcels, so going direct to consumer all the way from China, are close to 50% of the world's air freight now. And that is already being discussed to shut that down or to impose tariffs on it. Remember, those fly duty-free under the current regulations. And even the Biden administration has, and the current CBP has a directive, Customs and Border Protection, has a directive to take away those tariff exemptions. That may make those non-competitive. So there's a lot of different factors here. And I think you'll see an escalation because remember, these new tariffs are on top of the ones that the Trump and Biden administration put in. They're not, it's not just we're back to Trump's tariffs. Biden never took them away. And they'll be talking about adding on to those.
You mentioned Vietnam and you mentioned Mexico. And I just wonder, especially given some of the threats that we've heard from the Trump campaign, how much you see from the flows that Mexico is kind of a Trojan horse for Chinese goods, and the same with Vietnam.
Yeah, in both cases, you've seen exports from China to these countries increase by 20% over the last 2 years. And so that implies they're either moving goods there as raw materials into a manufacturing process, or in some cases, there's probably some fraud where they're just relabeling things and saying made in Mexico when it's actually made in China. I think it's probably much more of the former, much more of raw materials moving in. And so it's not necessarily, the market finds a way. You know, it's very hard to, when a country like China is so good at manufacturing, very hard for businesses to avoid using that. They're just going to have a competitive advantage, and the markets route around it. And The other factor here is that it's expensive. Trucking is expensive. So moving a container or a truckload of cargo from Mexico up to the United States is not cheaper than shipping a container from Vietnam to the United States. Ocean freight, the physics are unmatched. It's so much cheaper than land freight. So it's not necessarily that just because Mexico's closer in terms of distance that it's cheaper.
There's one sailing route I wanted to ask you about, given we are going to have a change of an administration come January. The Red Sea, do you think we're going to see more freight go through there?
We've already started to see a little bit of restoring of services through the Red Sea just in the last month, and that's before Trump, even anyone had an idea that Trump would win. Some carriers are starting to brave that. I think there's a real possibility for a breakthrough, but I don't have any insight into, what Trump might do with Iran or the Houthi rebels there. But I think you should expect a new set of initiatives, policies, and potentially military action. But very, very unclear. One interesting story I thought didn't get enough attention was that this allegation that the Houthis, the rebels in Yemen, or really the government in Yemen, has been taking bribes effectively and running a toll road to the tune of $2 billion a year from ocean carriers and ocean shippers to move cargo through as sort of a payoff to not shoot missiles at them. That's a really crazy development if true, and I like to see more about it. I don't have any sources on that other than reading it in the news.
Well, I know a reporter around this table that's going to chase that story a little bit more now, Ryan. Appreciate that. Ryan, let's do this again soon. This was super sharp. Really appreciate your time. Ryan Petersen there of Flexport. I want to talk about Mexico. The Deputy Trade Minister of Mexico came out in the last month or so. 70% of Mexico's imports from Asia come from about 50 foreign companies. A large chunk of those 50 foreign companies, American. And a large chunk of those American companies, auto parts, automakers. This is a big, big issue for America, and the president-elect wants to get on top of it.
Yeah, although it's so unclear where things are made and how much maybe goods from China or goods from the U.S. are just getting shuffled through 15 other countries to kind of, I don't know, not necessarily have an obvious origin.
I can't believe this stuff is still happening in the Red Sea. Still haven't cleared it up.
It's still happening, and actually it is adding to baseline inflation for a lot of these companies.
Up next, a look ahead to next week and a ton of economic data. Check out the markets, totally unchanged on the S&P 500. You can take a little bit of a breather this morning, at least so far. On the Nasdaq 100, we're down by 0.2%, coming into Friday at record highs. With 60 minutes until the opening bell, with your morning movers, here's Manus Cranny.
Jonathan, spoiler alert, 2 billion people have checked into an Airbnb in the lifetime of this company's existence. I helped them in the third quarter, but obviously not enough. Bookings were up 8%. So the issue is this. How are your margins? You're having to spend so much more on getting me through to the final click. That is what is weighing on this. The investments weighing on the margin. JP Morgan say it's about growth sustainability. Can it remain? If you look at the United States of America, okay, Marriott had a problem over the election, but the essence of it is we have a strong consumer here. Barclays says there's something for the bears and the bulls. They raised the price target to $110. They won't be put off. Now, Trade Desk, how do you synthesize TV advertising and online? Connect it up. That's the synthesis that you're looking for. Why is this stock down 10%? Bloomberg have put out their note. They think that there is a slowdown at hand to come, even though revenue grew by 27%. So a spoiler alert from Bloomberg Intelligence. How do you understand what's going on in China? $1.4 trillion worth of money has been made available to refinance the local debt. The reason why I picked Alibaba is what has been done to shore up the realm, defense of the realm of the consumer in China. On the macro side, we talk about the deflationary pushback or blowback into the United States of America from China. But here we are, consumer stocks. How do you defend yourself? You don't know what the tariffs are going to be. You don't know what the politics are going to be. And right now, the stimulus doesn't look as if it's on your side as a consumer. Jonathan, good morning.
Manus Cranny, good morning to you, sir. Appreciate it. And thank you for bringing up that stock just a bit softer in early trading. Lisa, I think it's interesting, the excuse that we hear, and we talked about this earlier this morning, that China's trying to save this ammunition for 2025 because they don't know what the policy is going to look like. Don't you want to get ahead of that? We talk all about this lags and all this stuff when it comes to policy. Don't you want to get ahead of that and do something about your domestic economy and make sure that it does have that resiliency to have things thrown at it?
So not to be a little cynical, but people have been making excuses for why we haven't gotten stimulus earlier. And they keep making excuses. And then they say, well, you actually see the effects of what's been put into place. And you have to start asking a question. Do they have the capacity and the willingness to actually put into effect the type of stimulus people are looking for, which stimulates consumer demand? That is really the key question. And honestly, an increasing number of people are saying maybe they just don't have the will or even the capability.
Yeah, you say excuses. It's actually just been one excuse, just the same one. On repeat, they're waiting. And then Donald Trump won. But they're still waiting. They're waiting to see what the policy is.
Exactly.
Then they're waiting. We're still waiting. We're waiting for 2025 and Fed policy and what it might look like. This is the view from Marc Giannoni of Barclays. We expect the FOMC to cut rates 25 basis points in December. However, in light of upward revisions to our inflation projections, we are changing our rate call for 2025. We now think the FOMC will cut rates only twice, by 25 basis points in March and in June. Marc joins us for more. Marc, good morning.
Good morning, John.
Let's start with that inflation projection. Upward revisions to our inflation projections. On what?
Well, what we learned this week is, with the results of the election, is that we will likely have an increase in tariffs next year, and we will likely have restrictions on immigration. And this is regardless of the outcome in the House of Representatives. So we think that with the tariffs, we are likely going to see an increase in prices, in the price level, that will increase inflation. We think already in 2025. We estimate that the tariffs could increase inflation by a good 0.5 percentage point next year. And then that might have some lingering effect in 2026. On top of that, restriction in immigration are going to, in our view, contribute to a tighter labor market. And with a tighter labor market, we are likely going to see a little bit more wage pressures by the end of next year. So all of that has contributed to raising our inflation forecast by about 0.4% next year and a little more in 2020.
So 2 points, tariffs and immigration.
Correct.
What are your working assumptions of what the tariffs will be, one, and what kind of immigration policies you expect to see?
So President-elect Trump has talked about imposing tariffs like 10% across the board, maybe 60% on China. We didn't take this full on board because we think that there's likely going to be some negotiation between the U.S. administration and other countries. So we basically took half of that effect, roughly. And so we think there's a lot of uncertainty around the magnitude of these tariffs. But in any case, this is what we started with as an operating assumption. And then with that, we think that that would contribute to roughly half of the effect that we would expect under the full 10%, 60% on China tariff imposition. So with this, we expect that that would contribute to roughly 0.5 percentage point on the price level, which would translate to about 0.4% next year's inflation, about 0.1%, 0.2% in 2026 inflation. And then on the immigration part, we think that President-elect Trump would impose tighter restrictions that the Biden administration has already imposed with the executive action starting in June. We think that that would lower the flow of immigration further. The assumptions that we make here is that we would return to something close to the flows of immigration we've seen under Trump 1, basically in 2017, 2018.
So going back to tariffs, is the big charge from tariffs the cost that gets implemented either on the producer or the consumer, or is it that it has to be made somewhere else, and that somewhere else has to be the United States at a time where you've got a tight labor market, reduced flow of immigration, and maybe not even the expertise in certain types of production?
Right. No, exactly. So it's all of the above. So there's a direct effect from increasing the price of imports. And then there's a little bit of an offset for an appreciation of the US dollar, potentially, that could undo some of these. But then, to your point, then you need to produce the goods domestically. And so you need resources to produce these goods domestically. So that would raise the price on other goods and services domestically as well. There are a lot of effects going back and forth, but the primary effect is basically the higher import prices, and then maybe some more demand internally that would raise all of them.
Marc, if they're going to be made in America, though, the future president is talking about a 15% corporate tax rate. Correct. Can that help bleed into potentially offsetting the increase you would see from tariff proposals, maybe decreasing the price of goods?
So I think longer term, potentially, but I think in the short run, you need to produce the production capacity and construct the plants and all that in order to have a bigger production capacity. And you need the workers to produce all of that output that's now required to be produced in the US. And if you put tariffs at the same time as you limit immigration flows, it's not clear where the workers are coming from. If we had a 10% unemployment rate at this point, I would say there's a lot of slack in the labor market. You can, of course, absorb a lot of the workers to produce that. But with an unemployment rate at close to 4%, basically with the labor market at full employment, and a population that's aging, and all the workers basically not really returning to the labor market, it's not clear at all who is going to be producing that increased output.
So this week you changed your forecast. This week we didn't get new Fed forecasts. They were asked about their old forecasts and Chairman Powell ummed and ahed. We get some new forecasts in December.
Correct.
How stout will those forecasts be in December? Because they're not going to take account for any of this until when?
Yeah, so Chairman Powell was asked a lot of these questions yesterday, and he said basically we're in the middle of that cycle here, and so it sounds like so far, even absent any of the Trump policies put in place next year, even absent all of these news, we've already seen very resilient labor market in September. We've seen upward revision to the GDP, national income accounts. We've seen firmer than expected inflation prints. All of that would suggest that basically the unemployment rate, if anything, is going to end up the year lower than the Fed had expected back in September, that activity is going to be slightly stronger, that inflation is going to be slightly more elevated. This is absent any of the new policies that might come in next year. On top of that, I think for next year, we can anticipate, as I argued in our forecast, like higher inflation and more activity and potentially a tighter labor market. So I think that implies that the rate path overall is going to be, will have to be slightly higher than what the Fed had penciled in.
So I wonder, especially since Jay Powell was talking about inflation as a new concern that they're putting on par with employment, I'm wondering how high the bar is for next week's CPI report to potentially torpedo the chance of a December rate cut.
I think basically the FOMC meeting yesterday with the statement and the press conference have basically left all the options open at the December meeting. Our baseline is still for the Fed to go with a 25 basis point cut because and Chair Powell repeated yesterday that they see policy as being still restrictive. They think they want to go to a closer and more neutral level of interest rate. And so we think that they really want to cut rates. But I think it's going to be a close call. And in particular, if the inflation print next week come in firmer than expected, we expect something around 0.3% for core CPI next week. That's going to be higher than what they had, presumably what they had anticipated at the September meeting. And then we'll have another CPI just before the December meeting. And we'll have also an important payroll report in November, in the November payroll report in early December. That one is going to be particularly important because it's going to tell us something about the underlying pace of job gains. Remember that the last month's print was particularly noisy due to the hurricanes and all that. We expect like a very big rebound in the payroll print.
What's a big rebound, just quickly? What kind of number?
Well, we think the underlying pace of job gains is around 150,000 a month. With the 10,000 job gains in October, we think we could have easily a print of like 250, 300 in early December, if indeed this underlying pace is around 150. So the picture of the economy when you sit down at the FOMC meeting in mid-December is going to be very different than the one that they've anticipated.
I've got to say, that doesn't sound like a rate cut in December.
That's what I was going to say.
That sounds like a pause, Marc. It's good to see you. It's good to catch up. Appreciate your new forecast. It's good to look through. Marc Giannoni there of Barclays. Looking ahead to CPI next Wednesday as well. They're looking for 0.3 on core. 0.3 on core. Equity futures right now on the S&P 500 just a little bit softer. We're down 0.1%. The opening bell is about 49 minutes away. We're looking at equity futures declining on the Nasdaq 100, but you have to bear in mind we came into Friday at record highs on the S&P, at record highs on the Nasdaq, and we're looking at a weekly gain that is the best weekly gain of the year so far. In fact, we had the best post-election day of gains ever in the history of markets, and we had the best Fed day of gains ever as well. Is that right?
That is. And what you're looking at is the flows back that up. I thought it was just really fascinating. $20 billion flowed into U.S. equity funds on Wednesday, the day after Donald Trump was presumed to be president-elect. So this, to me, really highlights just how much people are putting their money into some of these moves that we have seen in markets.
Truly historic. Subadra Rajappa is SocGen with us around a table. She jumps into the seat. Subadra, good morning. It's good to see you.
Good morning.
Marc Giannoni, Barclays just said 25 basis point cut in March next year, then in June, and that's it. 50 basis points in 25. That's your lot. What's the view at SocGen?
That's what the market's currently pricing in, is a December rate cut and maybe 2 cuts for next year. We still think that perhaps as the economy starts to slow down, the Fed will deliver as per the summary of economic projections. But there's really a lot of uncertainty around those around that call. And if anything, I think our bias is towards lesser cuts than what the summary of economic projections are showing.
Barclays is making some assumptions about the outlook, some assumptions about immigration, about trade. Do you think, for someone who's got to make a bond call, do you think it's too early to make those kind of calls? Or can we make some basic assumptions about what policy might look like from a Trump Volume 2?
I think at this point we have more questions than answers. So it's very, very challenging. And I've tried to go through that exercise in the last 24 to 48 hours on coming up with forecasts for treasuries. And, my base case would still be that for the remainder of the year, 10-year yields are going to be somewhere between 4% and 4.5%. And then going into next year is when we're going to start seeing a lot more volatility on possible outcomes based on whether tariffs get passed, whether there's more fiscal stimulus from tax cuts, and if immigration, and to what extent they're able to implement some of the policies that they have been discussing during the campaign.
There's so much still to go. Still not to work out whether we actually get a trifecta from the Republican Party, whether they can secure the House. And then once we work out whether they've secured the House, we've got to work out how workable the margins will be, whether there's any resistance in the lower chamber to some of the policies we saw on the campaign trail. And then, Lacey, you've got to work out what that means for the bond market. And I think that's the challenge we had all week. I think you framed it correctly. Other people have done the same thing. You can view it as a clearing event, 1, or you can view it as an event that redefines the macro outlook, 2. And if you ask people at the moment on Wall Street, they'll have a mix of 1 and 2, or one or the other.
Right. What it seems like is people in equities are saying it was a clearing event. And that honestly has been the takeaway that I've gotten from all the people we've spoken to. In bonds, it's more of a question mark. And I think Jim Bianco put it perfectly, which is we shouldn't be just accustomed to 15 basis point swings in Treasury yields at any given time as being the new normal.
Subadra, how do you view it? Was it a clearing event, or does it redefine the macro outlook? Or is it still too soon to say?
I think it's too soon to say. But what the price action was in the bond market for this week was that we got through a key risk event. We saw volatility come down quite sharply once we got through the elections. The initial knee-jerk reaction was for a sell-off and a steepening of the yield curve, which is what a majority of the market was anticipating. But given the fact that the positioning was relatively clean heading into the elections, and the fact that the market was quite almost fully priced in for a Trump scenario, I think what you saw after the election was for the market to take a little bit of a breather.
We also rallied on Monday, which probably didn't help. We rallied on Monday following that poll from Iowa over the weekend, which set us up to get kicked in the other direction.
Really, I think that's a great point, which is we had been pricing in something, then we priced it out, and then we priced it back in, which goes to this 15 basis point whipsaw action that we've been getting. Subadra, you think that actually we're in a range here, and that people are getting over their skis talking about the potential for 5% Treasury yields in 10 years and all of these types of more excessive potential moves. What makes you so confident at a time when some people are saying market participants are just waking up to the fact that this economy had plenty of inflation and growth already baked in?
So going into year end, I think it's going to be pretty much range bound. I think investors are going to be a little bit more cautious. You typically tend to see that heading into year end. But beyond that, you're really going to start seeing the market focus on the impact of tariffs. I think that if tariffs, in addition to the fact that inflation is already ticking up. We had 0.3 in CPI for the last print that we got, and then probably another 0.3 month-over-month for November that in the print that we're going to get next week. I think inflation is still very much a concern, and then add to that any sort of fiscal stimulus that you could get from the Trump administration. There's a concern that inflation is going to be something that's going to be high and persistent next year, and in that sort of environment, it's going to be very, very challenging for the Fed to cut rates, aggressively, even if employment is starting to moderate. So it's going to be that sort of tug of war between what the impact is going to be on inflation and the dynamics around employment and growth.
So, Subadra, the Fed may have to be on pause, but how quickly are we going to see the ECB move? Are they just going to be pedal to the metal?
I think that they're in a very, very tough situation because on the one hand, you're looking at the impact of tariffs, affecting Europe a lot more meaningfully than perhaps even China. And so they're going to need to kind of balance that aspect of the impact of policies from the Trump administration, and then you also have to look at changes, elections in Germany, and other sort of geopolitical risks and the dynamics around geopolitics changing quite meaningfully next year. So they have a very tough balancing act, but I think the bias is that the ECB cuts more than the Fed for next year.
Are they the biggest loser in this new regime?
You mean Europe?
Yeah.
Potentially, but we'll be watching to see what the specifics are and how much the Trump administration can actually pass and what impact that would have over the medium term.
Sebastien, just a final question. Mm-hmm. How do you write an outlook for 2025? I was thinking of this earlier. Typically around now, they're already getting published. Obviously, we've waited for the US election, but how do you put one together? You just put various scenarios. What do you do? What are you and the team doing?
I must say this is going to be one of the most challenging years to come up with an accurate forecast for how things are going to pan out next year. Because on the one hand, you have the dynamics of inflation, which could keep the front end, pegged, or there's also people saying maybe they would not even cut rates or hike. There's that dynamic on the front end. Then on the long end, you have to kind of suss out what the impact is going to be on growth. Is it going to slow down growth? Or is that going to be inflationary and you start seeing a meaningful rise in inflation expectations across the curve? So this is a very, very confusing environment to really come up with forecasts. So we'll be spending the next couple of weeks trying to suss out the probabilities.
I'm in the cheap seats. This is easy. Your job's super hard right now, looking out to 2025, that's for sure.
I'm just Googling where we can buy dartboards and how expensive they actually are.
And blindfolds.
And blindfolds, so that we can make sure to get our forecasts up in good shape for surveillance come, year end.
Super difficult. Subadra, it's good to see you. Appreciate your time. Thank you. Subadra Rajappa there of SocGen. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Tesla is now offering lease options for its Cybertruck. Prices start at $999 per month for 3 years for customers who put down $7,500. The EV maker introduced the lease option after working through the truck's back orders. Last month, Tesla told investors the Cybertruck was its third best-selling model in the U.S. in the last quarter. Rudy Giuliani has 1 week to surrender his assets. A federal judge said the former New York City mayor must turn over his Mercedes-Benz and a collection of luxury watches to 2 2020 poll workers. It's part of a $148 million defamation judgment. Giuliani told reporters the case is political persecution. Wells Fargo bank analyst Mike Mayo says the election of Donald Trump is nothing short of a sea change for the industry. The Wall Street veteran telling Bloomberg, quote, "This has been one long, harsh regulatory cycle for banks. Now the expectation is for a paradigm shift that prioritizes economics over politics." The S&P 500 Financials Index has surged 30% since Trump was reelected earlier this week. That's your brief. John.
Hey, Danny, thank you. Thanks for this morning, and thank you for this week. Up next, we'll set you up for the week ahead, looking ahead to inflation data in America. From New York, this is Bloomberg. open in about 36 minutes away. Equity futures on the S&P just a little bit softer. Looking ahead to next week, before we get there, you've got this, and I know you're going to hang around for it. UMich consumer sentiment at 10 a.m. Eastern Time. Mike's going to take care of all that. Then next week, Tuesday, Home Depot earnings, Wednesday, CPI, Thursday, PPI, and another round of claims, plus Disney Resorts, and Friday, retail sales as well. Mike McKee, let's start with CPI. What are you looking for? And to Lisa's point, are we making CPI reports great again?
We're making CPI reports great again, but jobs will also play a role. We're getting back to the dual mandate worries that we had. CPI is expected to come in unchanged, basically, a little bit stronger on the monthly basis and unchanged. Well, the headline is expected to go up. Now, that's not a good headline for people's psychology. The Fed will look through it a little bit because a lot of it will be costs that went up because of the hurricane, used cars, lumber, stuff like that. But then we get another CPI before the next Fed meeting. So the Fed has plenty of inflation data to look at.
Are you excited for University of Michigan sentiment survey and the inflation forecast 5 to 10 year out?
I would be, except that this is 2 days after the election. So I don't think they had a lot of time to get data in, but I'm certainly going to ask Joanne Shu about that and whether or not it reflects. I mean, if you look at the sentiment by political party, it's like an X whenever the party changes power. So it'll be interesting to see if Republicans are all of a sudden thinking things are great and Democrats, well, we know they think things are miserable, but we'll see if it reflected in the...
Anne-Marie with quote of the week early this week. We've already had Michigan sentiment. We got it Tuesday night, Wednesday morning. Mike McKee, thank you, sir. Coming up on Monday, don't miss this lineup. Chris Harvey, Wells Fargo, Neela Richardson, ADP, IBM Vice Chairman, Gary Cohn, the former NEC director. Looking forward to that. Plus, Oksana Aronoff of JP Morgan Asset Management. From New York City, you are almost there. Enjoy your weekend. Thank you very much for choosing Bloomberg TV all week. This was Bloomberg Surveillance.